It's weird. My chat box is not showing up. There it goes. Check, mic check. Check 1, 2. Big day today. I got smoked yesterday at the end of the day, and a fucking trade. I got to make my money back this morning, or this afternoon, or hopefully at the close today. Talk about that too. Pound some water. Just a second here, guys. I'm like losing my voice. I recall smoking a cigarette on Sunday. You know that means I was drinking quite liberally. Thought about it yesterday. I don't think I've smoked a cigarette in like 20 or 30 years. Check 1, 2. We have a lot to go over this morning. Wait, I'm in the wrong charts here. Looking at USD, JPY. Gonna check out Gamma. Turn that off. In a second here, guys. I'm a little behind. We've got FOMC. Good morning, by the way. Let's have a little sip of coffee here together. I've got a dog on strike, a dog that only wants to be walked. I've got 2 cats trying to sleep with me at nighttime. I've got angry animals. My wife and daughters are away while I'm at home, and I'm taking off and doing my own thing at the same time. So when I get back to the house, my animals are pissed. I don't know if they're completely pissed at me or if they're pissed off that the rest of the family is not here. I got a few things I got to do here in the background. We have a lot to go over this morning. There's like mountains of information that does not seem to want to. It's like information overload. I don't know if I can actually keep up with it. It's like at some point I'm like, this is just too much. Hold on a second here. I want to do one quick thing here. See if anything's changed here. Hold on, let's go over to the main screen. I apologize. Let's take a look. The gamma flip has come down significantly. It's now at 57.50. Man, call wall local resistance is at 5,700. Let me take a peek here. 5650 is kind of trafficy. There's some resistance here from 5650. Let me get down here and show you guys this. There's this is wrong here. Okay, so we're still in a negative gamma regime. The gamma flip is hot or lower. It's at 5750-ish, somewhere in here, but there's a ton of, you could call this the call wall right here. This local resistance is more like a band. I'll post this in the Discord for you. It's mostly like a band of volatility in here. Better way to describe it. There's a bunch of put gamma in here at different strikes. Let's see here. I don't want to call that local resistance. Let me just call it volatility. Right there. This is a put wall that was put in yesterday. It's pretty significant put wall here at 5,600. Now, if we breach this, $600, 5,500, 500. This is nothing now. And I wrote target down here this morning. I would call this local support. And the reason why I'm calling this local support, this is the put wall, but there's a giant fucking bar down here. I was on futures this morning, and there's a glaring buy zone down below. So just be aware, or conscious of, if we trade higher and begin to trade down today during FOMC, there's a screaming bunch of demand down here to buy. Now, saying that, if we're down here and we're buying, we can't get trapped in under 5,600. So there could be a bull trap in here too. So just be aware of that. I don't like this 5,600 at all. Like losing this 5,600. I'll show you why here in a few minutes. But the more important question would be, if we break down below here and get underneath the prior low here. It's telling you that we have to go much, much, much deeper and lower. And once you get that second low, that's it. You know, we're like staircasing to the downside. So we'll pay close attention to this. I have some news to go over with this with you as well. Some news from this morning. Like, hold on here. What do I got for you? GS's Pravotsky is saying the U.S. remains choppy and feels like we've had the oversold bounce, which I don't believe in at this moment. But he's saying it feels like we've had the oversold bounce. In fairness, thought a bit more upside, but nonetheless, the policy path there remains incredibly murky. And there are real questions being asked about the state of the low-end consumer. We can talk about that this morning. When retail sales came in the other day, the state of the consumer looks great. There was one faulty part of retail sales, and that was restaurant sales were kind of shitty. That could be bad, and that's how you manufacture a recession. None of the data supports a recession, but if people say, well, I'm going to tighten my purse strings, they can manufacture their own recession. Now, retail sales look great everywhere else. It could also be something where people are unwilling to pay for the cost of a restaurant right now. And as a matter of fact, grocery sales increased. And we've seen this before. We saw this once, I believe, in 24 or 3, where people became fed up with McDonald's and shifted their dining habits to grocery stores, and then eventually traded up for a better restaurant experience. We can look at that this morning as well. But Pravorsky is harping on that one data point that is not relevant today. It can be down the road, but it isn't today. So it's just more bearishness or a bear thesis. He wants more down, and he's using that as an excuse from retail sales. He goes on to say, not in the camp of pressing for more downside. Thought above 5,800 it was a sell, but here it's just a choppy. Technically, there could be multiple buyers on a rally, gearing up for a big pension fund rebalancing into month quarter end. CTA max short, sentiment very low, and vol control largely done for now. Vol control I disagree with. They popped up yesterday, and that's what's making us choppy. I don't know why he's saying that. So again, all the elements are there, but you're lacking anything fundamental to give you support. Where is the executive put? Where is the Fed put? In a brief last night, I talked about. It's funny that he's talking about all this stuff because most of this, not all of it, the retail sales wasn't in the brief, but most of the rest of this stuff was. Where is the executive put? Where is the Fed put? I think at this point, Wall Street. I think where is the executive put is a good question from Wall Street that has stated that they're going to take Trump seriously, but not literally. And at this point, there's a question. Do we start taking him literally? Do you start to wonder if SCOTUS and judges have no teeth? Yesterday, a Trump insider or a White House advisor yesterday said the courts do not have an army. That is not any good. That is not good. Hearing stuff like that. As far as the Fed put, we know that Jerome Powell's chair is ending in May. So you've got economic conditions where we don't really call for a cut nor a hike. We're in this place where we're not due for either. And so Jerome is kind of for lack of a better word, he's hogtied, and his chair is up in May. So what is he to do? Slow and end QT would be one answer, but that's for a whole nother reason. So that's a tough one. What Pravotsky is saying. Now, so the Fed put is kind of out the window right now. The executive put, you're going from the beginning of take them serious but not literal. Let's say that's a 1 through a 3, now cranking over to a 7. And you saw a daft attempt by Trump yesterday to give a small executive put to manipulate the market, and that was thrown right out the fucking window yesterday as more bullshit. So I don't think you're going to see that. Maybe, I guess, at any point, that sentiment can flip. But I don't think you're going to. I think you're getting egg on the face on Trump right now on that executive put. And not only that, we'll talk later today if we can get into it with perception, being objective and being subjective in your perception as what the general public thinks about Trump. I think you had 36% of eligible voters voted for Trump. Let's be real about this. You've got 36% of eligible voters voting for Trump. You've got some Trump supporters that are for Trump, but not for everything he's doing. So you have an all-time low of satisfaction with Trump amongst all Americans, right? So you might have 30% of Americans, maybe even less, 25 that actually are rah-rah for all of this. You've got the other, let's not say 75 or 70%, but a good portion, 50, 60% that are not happy in any way, shape, or form. That is, whether you want to admit to that or not, glaring in the public. It's glaring in the data that's beginning to come out. It's glaring everywhere. Everywhere you look, there is doom being spewed. It's so bad that I was just on the phone with a friend of mine, and I said to him, it's very rare to see a populace put themselves into a recession themselves. Not like, hey, I'm being faced with high unemployment, I'm being faced with high inflation, I'm being faced with no money flow. All these reasons that are out of your control. Instead, it turns into, I'm going to create this. And this might even be proponents of Trump policy that are still not telling you publicly that even they have some fear as to what the outcome may be. And it doesn't help when you have Doge, Elon, and Trump themselves. Even Besant, to some extent, has admitted the same thing. We don't mind if we send us into a recession. That scares Bob on Main Street, Mary the landscaper, all the regular people out there. And I'll quote some Besant quotes later this morning if I can get to it. But we will go over it at some point today if I can. So that's GS's Pravotsky this morning. GS's Chavone saying QT is more important than dots. The Fed's primary goal seems to be controlling volatility, suggesting QT adjustments may take precedence over rate cut projections. I will go over that with you today. This is kind of bizarre. In 2019, we had a crash due to not having enough money in the checking account. And so we'll go over that in detail today about QT and the slowing of QT, why you do that. They want to load the checking account because of the volume of money that's going to be requested from that account. So we'll talk about that this morning as well. We'll get into some of that stuff too. All right, so let's go look at this thing one more time. Keep your eyes on this lower swoop down here, right? And then also if we get caught underneath this 5,600, you catch the low and then it's on like Donkey Kong to the downside. This hasn't happened yet, but I would expect today to have something possibly like that happen today. So we're going to go look. Hold on a second here. We can make sure I got all this right. Yeah, I got all this right. I'm just going to post this inside of the Discord for you. I'll post hold on a second here. And I will also post I'll post a net gamma chart for you. Where are we? Dude, it's so weird. I've got like no updates that I'm not getting any updates from Discord either. We got really bizarre shit going on with Discord right now. So you can see this. Two-day. Where's two-day? Net gamma two-day. I got some net gamma two-day option data here for you too. Ping pong, ping pong. Hang tight for 1 second here. Oh, sorry, I'm not on the wrong screen here. All right, let's go over to the trigger screen really quick. Now, yesterday, let's take a quick look at yesterday. Where are we at here? Okay, so here's yesterday right here. So this here at 9:30 yesterday, we expected a trade higher and then the move lower, and instead they came right in and sold right on the open. So beware of that this morning as well. Now, it doesn't look like we're going to get that this morning, but just be aware of it that at any point, I've got this charted out to 10:30 in the morning. Let me see, 10:30. Got this charted out till 10:30, and then I'm looking for that swoop lower into the Fed meeting here. But oh, wait a minute, 10:30. This is 2:30. I should probably slide that over a little bit. Rechart that. Where is 2 p.m.? Like, I'm looking for blood. I am. I want to see some blood here. And then an escape to the right. Now, the one thing I want to show you here is This is that lower bound down here at 550. And this is S4 down here. And S5 right here. I just want to measure this really quick too. So that's a 1% move right here to 566. 1% move. This daily up here is another 1%. Or I guess if we squeezed up, we got the Fed. If you get the Fed meeting, top target 569.77. You're going to do a strangle or a spread or anything like that. 569.77. 1% move is right here. But if we bleed off down here, that's 2% move right there. That's basically a 2% move. Three all day long together. So I would take into account this down here. It's saying a 1% up or downside moves, like 1% basically here or here, depending on what price is. Then down here, 2%. If you want to snip that, you're more than welcome to. This stuff never fucking stuff never scales right. Next up, we've got the question from Provotsky this morning was, let me go back to this really quick. The U.S. remains choppy and feels like we've had an oversold bounce. In fairness, though, a bit more upside, but nonetheless, policy path there remains incredibly murky. And there are real questions being asked about the state of the low-end consumer. Dude, where is my place here? I want to talk to you about that really quick. Where sales are weak amid falling prices of what they sell. Sales at food service and drinking places fell by 1.5% in February from January, which reduced the year-over-year gain to just 1.5. Holy shit. Hell yeah, it's squeezing. 1.5% in February from January, which reduced the year-over-year gain to just 1.5% seasonally adjusted. The past 3 months, December through February, have been weak. This is something we're going to have to keep our eyes on because CPI from food away from home, which tracks inflation in restaurants and other eateries, has continued to rise at a substantial clip. 0.4% month to month and 3.7% year over year in February. Through November, sales in this sector have been growing strongly, but now there's this decline. If this turns into a trend with another lousy reading in March, it's something bigger to be fretting over. And that's to the point of there are real questions being asked about the state of the low-end consumer. Technically, there could be multiple buyers on this rally, gearing up for a big pension fund rebalancing into month quarter end. CTAs max short, sentiment very low, and vol control mostly done from now. So again, all the elements are there, but you're lacking anything fundamental to give you support. The next two questions from Pravotsky this morning was, where is the executive put? Where is the Fed put? Dude, we're still squeezing. Hell yes. Just a note here, back in June of 2024, there was discussion of slowing or stopping QT. On June 12th of 2024, we squeezed from, I think, 8 or 8:30 in the morning into the open, the first half an hour of open. Then the market pinned, traded sideways, blasted down, and then traded up into the close. And over 3 or 4 sessions, it began to rise violently to the upside on that QT. I'm going to read to you a little bit about QT so I can get it out of the way. This is from Wolf Street. Why the Fed is considering pausing or slowing QT until the resolution of the debt ceiling situation. The minutes mentioned it. The New York Fed's Pearly added some background. The Fed will likely provide details at its March meeting. That's right now. No one has ever drained $2.2 trillion in liquidity through QT from the financial markets, as the Fed has done since July 2022, and there is no playbook to go by. Withdrawing liquidity too fast can cause some places to run dry, while others are still awash in it. Normally, higher yields cause liquidity to move where it's needed, but if it drains too fast, there may not be enough time for yields to do their job distributing liquidity, and then something blows out, like the repo market did in 2019. An accident like that would cause QT to stop, and the Fed has consistently said it wants to avoid another accident. Oh, wait a minute. which is why it slowed QT in June 2024 so that QT can keep going further. And now there's a new potential issue for the Fed. For its balance sheet and liquidity in the financial system, the debt ceiling fight, and the $800 billion checking account of the federal government. When $800 billion in liquidity suddenly pours into financial markets and then vanishes from the financial markets even faster, it moves the needle. The first official mention came in the minutes of the January 28-29 FOMC meeting. The FOMC is considering, quote, pausing or slowing balance sheet runoff until the resolution of this event. So not stopping QT entirely, but pausing or slowing it temporarily until the issues of the debt ceiling are resolved. Then on March 5th, the New York Fed's Roberto Perli, manager of the System Open Market Account, which handles the Fed's securities transactions, gave a speech about the more distant future of the Fed's balance sheet, which paralleled what Dallas Fed President Lori Logan had said earlier this month. Future of the Fed's balance sheet, how assets might shift from longer-term securities to shorter-term T-bills, repos, and loans after QT ends. MBS entirely off the list. But Perli included a detailed discussion about the near-term issue related to the debt ceiling. While the debt ceiling is in place, the government cannot raise more cash by issuing new Treasury securities and instead will run down its checking account at the Fed. The Treasury General Account, the TGA, a liability on the Fed's balance sheet. Before the debt ceiling was reached, the TGA had a balance of over $800 billion, which is what the Treasury Department normally wants to keep in it. While the debt ceiling persists, that balance will be drawn down. It has already been drawn down to $530 billion. In past debt ceiling fights, it was drawn down to near zero. This is AKA 2019. Drawing down the TGA effectively injects liquidity into the financial system, potentially close to $800 billion. But that's not the problem. The problem occurs when the debt ceiling gets lifted and the government refills the TGA rapidly by issuing lots of T-bills, which sucks that liquidity back out of the financial system. And very quickly. That's a bad thing, by the way. Last time $500 billion got sucked out of the financial system in 8 weeks in June and July 2023, and another $300 billion got sucked out over the next 12 weeks to refill the TGA back to $800 billion by mid-October 2023. That was a lot of liquidity to vanish from the financial system in a short time. Last time, the overnight reverse repo on RRP facility at the Fed, by which money markets deposit unneeded cash at the Fed to earn some interest, still had $2.1 trillion in balances. And that's where the $500 billion came out of in June and July 2023, and the $300 billion in August to mid-October 2023. It was smooth. Money market funds bought the massive amounts of T-bills the government issued during the TGA refilling process and paid for them with cash they got from exiting their on-RRP positions at the Fed. The cash went from the Fed's on-RRPs via money markets to the TGA. Both the on-RRPs and the TGA are liabilities on the Fed's books. It didn't impact the Fed's assets, and it didn't impact banking liquidity. It was unused cash from the money market funds that funded those T-bill sales. But this time around, QT largely drained on RRPs and is starting to drain liquidity from the banking system. The banks keep large amounts of cash on deposit at the Fed in their reserve accounts, as the Fed calls them. With the reserve accounts, the Fed acts like a central clearing place for bank transactions. Banks pay each other on a daily basis through the reserve accounts at the Fed. Huge amounts of cash flow through these reserve accounts every day. In addition, banks keep substantial amounts of cash in their reserve accounts for financial stability purposes, because it is the most liquid cash. These reserve balances are what the Fed is trying to reduce with its QT, and they haven't come down yet at all because all of the QT, oh yeah, keep on squeezing, baby. These reserve balances are what the Fed is trying to reduce with its QT, and they haven't come down yet at all because all of the QT came out of the on RRPs. And now, during the debt ceiling, liquidity is moving from the TGA to reserves. So now that liquidity needed to buy the $800 billion in T-bills that the government will issue to replenish the TGA will largely come out of the banking system, including reserve balances. God damn, that's a lot to say. Woo. But the TGA is now also draining due to the debt ceiling, and part of that liquidity is going into reserves, thereby temporarily covering up the drain on reserves from QT. And this liquidity from the TGA now pouring into reserves is obscuring the effects of QT on reserves. That's what the Fed is fretting about. So listen to this line closely. The TGA is also now draining due to the debt ceiling, and part of that liquidity is going into the reserves, thereby temporarily covering up the drain on reserves from QT. And this liquidity from the TGA now pouring into reserves is obscuring the effects of QT on reserves. That's what the Fed is fretting about. After the debt ceiling is resolved, the government will refill the TGA quickly, and this sucks liquidity back out of the reserves very fast, much faster than QT, potentially hundreds of billions of dollars in weeks. The Fed is worried about the speed with which this happens after the debt ceiling, and that its signaling systems, such as surging yields and spreads related to repo markets, will warn of reserves being low enough near ample in real time, rather than in advance, by which time it may be too late and the liquidity demand could cause some major gyrations in the money markets, similar to the repo market blowout that occurred in the fall of 2019. In his speech, Perley noted that reserves are still abundant and not yet ample. I want to make a note to you this morning that you want to be listening closely to Jerome Powell in anything that he says that references either of those two words, abundant or ample. So if you're a crayon eater, trader, you're just listening for abundant or ample. But noted that there is evidence that pressures in the repo market have been gradually increasing. He added, for now, these signals from the repo market suggest no cause for concern. The idea here is that the Fed will likely introduce this slowing or even pausing of QT that could start today or possibly in May or June. But it will become something that is, R2 is 567.64. In his speech, sorry about that. And he said with regards to the rates and spreads they're following, quote, with the partial exception of the repo indicator, these measures are currently all toward the top of the chart and about in line with their benign levels of a year ago. I want to warn you that there are a lot of news articles stating that the reason for the pause in QT is because of deteriorating economic conditions. That is not the case. Quote, on the other hand, you can see that during periods when reserves were becoming less ample, as was the case in 2018-19, these indicators tended to show more movement and were further toward the bottom of the chart. This is the chart that he referenced. I added the red box to show the period when trouble in the repo market arose after QT drew down reserves. You're not going to be able to read this here. It says I can click on this, but we're not going to be able to read this here. Quote, pausing or slowing balance sheet runoff until the resolution of the debt ceiling situation to forestall a blowout in the repo market or other segments of the money markets. The Fed said in the minutes that it is considering, quote, pausing or slowing balance sheet runoff until the resolution of this event. I do want you to know that if they do announce this today, you could see upside movement in Bitcoin, currencies, which are good for the stock market right now. Quote, sharp and sudden changes in the supply or demand for reserves to the TGA getting drained and then refilled could in principle prompt reserve conditions to shift rapidly, depriving our indicators of much of their early warning potential. One factor that could lead to large and relatively fast swings in reserves is dynamics related to the federal debt limit, not economic conditions, the debt ceiling, the debt limit. Put simply, the longer balance sheet runoff continues while the debt ceiling situation persists, the higher the risk that upon the resolution of the debt ceiling, reserves could rapidly decline to levels that could result in considerable volatility in money markets. Again, when you're trying to stabilize money markets, it's usually risk on, aka if you're a Bitcoin bro, well, this could be your day. As noted in the minutes of the January 2025 FOMC meeting, various participants thought it may be appropriate to consider pausing or slowing balance sheet runoff until the resolution of the debt ceiling situation. The back-to-back announcements about pausing or slowing balance sheet runoff until the resolution of the debt ceiling situation indicate that the Fed will provide further details fairly soon, likely on March 19th, today, at the FOMC meeting. Did the retail sales thing? I was going to discuss Canada, but we're not going to talk about them just now. I have some other questions here about who's holding government debt, but we'll talk about that later too. It is a key point here to note that the Fed put today will likely come in the form of this slowing of QT. It's probably the only thing that Jerome Powell can do at this point. There is no need for rate cuts. And not only that, his hands are tied with his chairmanship being up in May. He'll still be a member of, if he's cut loose. If he is cut loose, and I read back on Trump here. Let me read you two articles. I'm going to read you a few articles. I'm going to go peel back a little bit, back into December of last year, just after Trump won the election. Federal Reserve Chair Jay Powell can finish his. This is a quote from Besant. Federal Reserve Chair Powell can, not Chair Powell, but Jerome Powell can finish his term leading the U.S. Central Bank, said Scott Bessent, a hedge fund magnate and President-elect Donald Trump's pick for Treasury Secretary, despite prior insinuations that he could be pushed to step down. If you also recall, maybe it might be in this article. Hold on. As the president said on Sunday, and I'm in complete agreement with him, that Jay Powell will serve out his term. Bessent told CNBC after Tuesday meeting with Mike Crapo of Idaho. Bessent's comments come amid mounting speculation around the fate of Powell following Trump's victory in the presidential race last month. While Trump has had a strained relationship with Powell, the incoming president told NBC News over the weekend that he would likely not try to remove the Fed chair. Trump told NBC News that Powell would likely step down if told, but would not if asked. We can see at this point that none of that has happened. However, the president-elect said he did not have plans to do that at the moment. Bessent's statements mark a turn for the key Square Group founder, who previously floated the idea of a shadow chair to run the Fed. There was some talk of that, I want to say in December, January, of having that shadow chair, or that Trump would have tried to assert power over the Fed. The idea was that Doge would come. I think it was that Doge would come in, and rather than the Fed collect the data and then dispense it to you and I, that the president, the executive branch would provide that data to the Fed to then dispense to you, asserting that power over the Federal Reserve and likely Treasury. That's kind of murky at this point. None of that's going on at this point. There's been pushback to that when Powell's been asked. Powell's term as chair ends in May 2026. Also note that he's still a member of the Fed, I believe, until he's still a member of the Fed. I want to say until 2028 at some point. Trump chose him to lead the central bank, a role Powell took in 2018. President Biden reappointed him to another 4-year term in 2022. Powell has said that he did not believe Trump could legally push him out of the position, would not step down if he was asked. Now, this was back in December. And then in January, Bloomberg came out with, one quick second here. Bloomberg that came out with an article in mid-January of 2025 from Ben Emmons, the founder and OCIO of FedWatch Advisors. And he goes on to say, in her speech last week, Fed Reserve Governor Michelle Bowman reflected on the current policy stance. She believes that the recent 100 basis points worth of rate cuts brought the policy rate closer to the neutral rate. Yet by cutting interest rates, the Fed's actions may have contributed to the economy's acceleration by raising the neutral rate. Policy may not be as restrictive as thought. In the context of the Taylor rule, a policy close to neutral is when the economy is balanced. Now, remember, this is January, but core PCE is still above target and the unemployment rate is below the natural rate. The economy may instead be growing faster than potential output. For policy to be neutral, the natural real interest rate must be around the longer-term trend of the economy, approximated by the sum of productivity and population growth. While estimates vary, the Fed's models indicate a range of 2.53% in real terms, assuming inflation is close to target. If Bowman is correct, the policy rate of 4.5 in the proximity of neutral gives the Fed no room to lower rates. At the same time, neutral policy means an economy must be in equilibrium, which does not require raising rates. Also note that the 3- and 6-month bills are being pumped out to deal with the expected and realized front-running of greedflation geared towards tariffs. And you can see the longer rates right now still are fine. In the proximity of neutral gives the Fed no room to lower rates. At the same time, neutral policy means an economy must be in equilibrium, which does not require raising rates. Also note that sentiment is driving us into an yet-to-be-realized recession, as well as where prices are in the stock market. And thus, the economic data are putting the Fed in a lame duck position at the current juncture. There is no compelling case to move rates in either direction. At the same time, financial conditions are tightening, and the equity markets may begin to build pressure for another rate cut. Politically, the Fed could become even more of a lame duck, with Republicans calling for both lower inflation and substantially lower rates. And that's not happening, is it? The central bank's message must be more hawkish than the current policy stance. This means markets must take the leadership by lifting the bond yields further into restrictive territory while the Fed stays sidelined. The concept of a lame duck Fed is a concern to investors. Listen to this part closely. If economic data prevents the central bank from acting when required, for example, in a liquidity or bank crisis, then the market will do the opposite of the Fed's role as lender of last resort. The recent rise in yields may have something to do with growing recognition of a sidelined Fed. Think about that with the possible announcement of QT being slowed or paused today. The recent rise in yields may have something to do with the growing recognition of a sideline Fed, as well as the term premium reflecting expectations for growth, inflation, and fiscal deficit. Now, that whole thing has changed as of today, hasn't it? The term premium and the estimate for the neutral rate have been less accounted for, but show a strong relationship. Since the fall, each began to accelerate as the economy strengthened into and after the election, as animal spirits, quote unquote, picked up. The Fed cannot act meaningfully if expectations for economic growth continue to ramp up, which simultaneously drives up the neutral rate and term premium. It's saying here that the market will take care of this for the lame duck Fed. Now, after this, it's been pushed that Neil Kashkari could possibly take over for the Fed chair in May. He's been floated as an heir apparent. What's also interesting is I haven't seen Neil Kashkari in public at all. I tried to look up a bunch of articles on him in the past month, tried to look up on socials on him. Very brief public awareness of Neil at this point. This guy right here was at one time a mega dove. And then he became a mega hawk. If you remember in the early 2020s, he was a super hawk. Now it is questioning if Neil is going to be, if Neil is going to kneel to Trump and what he wants. And I do find it fascinating that there's no discussion about Neil as an heir apparent for Trump to replace Jerome Powell. Take that into consideration today. When you hear Jerome Powell speaking, is he kind of have his hands tied here or not? This might be the last thing that Jerome can do is through QT, slowing and pausing to not disrupt markets. Whew, I'm not going to go into his bio. I was going to talk about his bio, but I don't think I need to. I think all of you know Neil Kashkari well enough. White House senior advisor Hassett saying the Fed is likely a little tighter than equilibrium right now. I see the Fed weighing a shift to cruise control in meetings. A note that Zelensky will call U.S. President Trump at 10 a.m. A side note on that, did you know that Putin kept Trump waiting for an hour yesterday? White House economic advisor Hassett also going on to say he spent last night with the Commerce Secretary and Treasury Secretary negotiating with other countries about mutually lowering tariffs ahead of the April 2nd reciprocal tariff deadline. Keep that on your notes, too, that theoretically Wall Street's trying to make the argument that we have not yet priced in tariffs. I tend to disagree with that unless we're making a trip higher and then maybe one more trip back down here to 50. I find it hard to believe that those are not priced in. 2-year note yields are spiking higher on bullish comments from B of A CEO Moynihan and the White House advisor Hassett. GS's Chavone saying QT is more important than dots. The Fed's primary goal seems to be controlling volatility, suggesting that QT adjustments might take precedent over rate cut projections. I want you to think about this article that I read to you earlier about from not just Wolf Richter saying that slowing the pace of QT stems that volatility, but also the idea that the markets, the bond markets, like the vigilantes out there, if they think the Fed is tied behind, hands are tied behind its backs, that they will cut themselves. And you can kind of see that the last month and a half, right? Some significant cuts around the market, stemming growth. And the mantra that's out there's a mantra, a sentiment of recession, right? Slowdowns. You can hear it everywhere. The drumbeat is huge. It's almost like there's not quite a presidential put, but a presidential put, or I guess a presidential put on growth, where the Fed won't stem it, the president is. GS's Chavone goes on to talk about the reaction following FOMC. Relief rally, positive for risk parity. Equities and FI could see a bounce as volatility declines from this QT pausing or slowing announcement. The pain trade, one rate cut and no changes to QT. No changes to QT. The market is pricing suggests a 60% chance of pause. This leads to a bull flattening and risk-off move. Positioning, limited directional bets, indicating that this Fed is not seen as a game changer. If you go back and look at the June of 2024 QT or discussion of slowing QT, we squeezed into the beginning of the morning and then flattened just like this. We squeezed, flattened, traded sideways, bounced down, recovered into the close, sideways for 2 or 3 sessions, and then began cranking to the upside. Coming into 10:30 now. Give me one quick second. I got to do something. Something is fucking wrong with the. Note that there's a lot of volatility here. Here's SPX. Just note that this is a big zone of volatility. We went over this morning at 9:30. Give me a second here, guys. I'm in a conversation here. Yeah. See these two bars down here? I'll show you this from this morning. Be careful. See these two bars over here? Be careful these two bars up here. There's one more bar up here. We could tag this one. Whoop. There's a tease up here. Maybe to trap liquidity. I still don't like this downside move right here. This is from earlier this morning. I don't know if you can see it over here. These fuckers are down here at 50. This is, I think that's 5,500. That down. Oh, I can't. I'm like, I don't know if I'm losing my fucking. I'm getting old. Oh, yeah. Bring it back down. Hold on a second. I need to turn on the. Apologize for not having the financial juice going in the background here. You guys hear this? There we go.
Israeli minister warns of further steps unless hostages are freed.
I'm sure some of you bears out there are going die, die, die right now to spoos, aren't you? Dirty fucking dogs.
Air Force attack against Hamas was, again, only
dirty fucking damn bears. Hold on a second here. Dude, how's that not showing up? White House National Security Advisor Waltz says that he and his Russian counterpart agreed for their technical teams to meet in Riyadh in the coming days to discuss the implementation and expansion of partial ceasefire. Oh, God. That Trump secured from Russia. White House National Security Advisor Waltz says that he and his Russian counterpart agreed for their technical teams to meet in Riyadh in the coming days to discuss the implementation of expansion of the partial ceasefire that Trump secured from Russia. I'll show you guys this one here. I'm going to post this one on Twitter. Hang tight, guys.
Italy's industry minister says we will ask the EU to prepare compensatory measures for sectors hit by US tariffs.
Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month and save 92%.
And the Trump-Zelensky call is supposedly happening right now. Yeah, also note today at today's Fed rate decision, we're also getting economic projections, interest rate projections year 1 and 2. Coming into a back test of the half hour and hourly trigger cross. Hold on, I gotta read this. What the fuck are they saying? Yeah. It's a neat little factoid here I got for you. That's kind of neat. I don't want to get new glasses. I can't read a goddamn thing. Be careful here of kind of being roped in. We've got until just be careful of like bouncing around here and then hedge coming onto the market into 2 p.m. What they're going to try to show you here is they'll try to show you. I'm not saying we're not going to squeeze up and out of here, but oftentimes on these, oftentimes we're going to talk about a few things here. So let's have a little fireside chat. So, back in June, right? The FOMC meeting, we squoze in the morning. We just like started cranking at like 8:30. We like cranked up and into right around 9:30, 10:30, something like that. We just went vertical, and then the market just paused. Now, oftentimes, let me go over here to this side. Let me go over here for a minute. Nice little squeeze up here, right? This was 8:30 this morning, or this 4 a.m., and then here's 8:30 right here. We ramped very similar to back in June of 2024. Last time we had this conversation, just like fucking super ramp. And, not that history repeats itself, but it oftentimes rhymes. So I do want you to be aware that, like on these FOMC dates, oftentimes you'll see, not every time, but oftentimes you'll see what looks like something bullish. You could see it was like trade down here, start to bounce like we're going to be up and away, hit that new high. We're off and we're out of here. But this is a day where dealers want to kind of fuck you, don't they? You've got expensive premium on calls and puts. And in reality, they want you to be able to play in here, but not get too crazy. Sometimes you get crazy. Sometimes you get crazy downside. Sometimes you get crazy upside. But you need to instigate. You need that, like, not just you buying calls, but everybody else buying calls, right? Or not just you buying puts, everybody else buying puts. The moment that the puts are done, they stopped counter hedging. Same thing with calls, right? You got like 15 minutes of put buying. They'll chase those puts, but the moment they stop, they try to fucking delta hedge your ass. They're going against you. They buy the market. Does that make sense? Same thing on the opposite or inverse with calls. And they would like nothing more than to sell you options in this zone and have all of those options fucking die. I mean, literally. We had a 2% move today. Well, I'm 1% up or down, right? Let's call it 1% up and down. That's 2% right there. Well, dealers are pricing in this move, right? Kind of like you can do whatever you want in here, you can do whatever you want down here, but you need to buy more puts. So here's an example. Let's say we get some negative news from the Fed or something that doesn't spark buying. They go all the way down here, and you're like slamming the put button, or you've already got puts. If there's no aggressive more put buy-in, right, they're going to buy the market and murder those puts into the close. They would like nothing more than to see this market die in here today. And not only them, but there's Condor and butterfly holders and sellers. And all they want to do is see the market do this too, right? Right into the close. That's all they want to see, right? And even if you were to get up and out of here, so you get up and out of here, whoop, they want it to come right back down again. Makes sense? The moment you stop buying those calls, right back down to this zone. So, what I will tell you is this. If you are trying to short or long, it's always better on these edges, especially if it's not really bad news. We just go down and we start bouncing. Kind of get long in there for a little while. Another note about today, FOMC days, is you'll see that we fail targets. Not so much this, but in here, when we're in this like 2 o'clock, let's say you've got this as your target. And you're like, I'm bulled up. I'm so bulled up, bro. When we come down here and we start to ram it up here, you'll see like, I fucked that up. You'll see like a failure here, reprice options, failure here, reprice options, failure here, reprice options. So they don't even care. And that, because this is the flip side. Even if we continue to go up and outside of what they expect, they're going to still try to murder your options. So you're like, oh, Cap, I bought a call for 50 cents. Why is it only worth 48 cents up here? Because of all this action in here. Okay. So I always like if I'm gonna take the risk on days like today, I always like the taking the money and running before you get there on FOMC or event days. But here's the better trade. in all honesty, the better trade on FOMC days. This doesn't work out every time. Hey, buddy. Sorry about this. Hold on a second here. I got sad dogs. So, let's say this is an FOMC day. Number one, you should not be trading your entire account on FOMC days. There are better setups than this garbage. But the safest way to trade this would be to let all of this happen, right, and hope for this to come back down into the close and buy the close on a low. Now, maybe it'll run away from you and you have to wait a day for it to come back down. But if you're a bull, try to stay down here somewhere or even lower, depending upon the news. And be positioned on these lows or even lower. Don't be chasing shit up here. Don't be like getting faked out until 2 p.m. You're buying calls, and then it slams you down into 2 p.m. and then they burn your calls, and then whoop, you're back up again. It would be better for you to let the market run away from you and say, I missed it, than if you just sit down here, FOMC after FOMC after FOMC after FOMC. Now, if we follow this path, let's just say we follow this path today. Follow this up, and let's say we come back down into, let's say, 2 p.m. and they launch us higher, right? And they sell us down into the bell, right? Pretend this is the close. They run you up here. They sell you right back down to the close, right? You're actually waiting for all of today to end so that options can be repriced. And then if you're going to go long, if you think that this was bullish and it's going to go higher, make sure you put some extra sessions. Thursday, Friday, Monday, Tuesday, Wednesday of next week to get a print to the upside. Now, this particular FOMC happens to fall upon OPEX and also month end on a quarterly OPEX with triple or quadruple witching, depending upon your definition of when that takes place. The dates now are different. Some people don't care about mixing things like that. There can be, we just run away and never come back too. If your thought is that we're going to ramp a Rama into the end of the month, we're going to get news. There is a possibility we never look back here too. But I wouldn't be trading that plan FOMC to FOMC. It's a very rare occurrence that we don't revisit that low again before the ramp out of here, even if it's just brief to the downside and up and away. Just be aware of that. If you wanted to know what my plan is for today, I'm looking for this low down here. I would even like to see us go lower. Today, tomorrow, even if we ramp up here, come down, ramp it up, and then just come back down here for that last little bit to the upside. Now, let's say I'm wrong in say Jerome is super bear hawk. He's angry. I think I said this in the stream yesterday. I bet I could bring up yesterday's stream, because I know I said it to you like 10 fucking times, which was, this is bad. But do not get short here into this close. You're going to wait for the rip to 50 or 564. And then if you really wanted to get short, you get short here. Now, the other thing that I told you in yesterday's stream was 5,600 would need to be broken, which I believe is right here. You would want to see, or hold on, I think 5,600 it's somewhere in here. I would want to see 5,600 broken and then a new low to get short, right? Get short down here, and then we can start making our way to the downside. But just note that yesterday we said that a put wall was being put in at 5,600, which I think is sitting, put wall is like right here. And the real danger of this put wall is if it gets broken, we start staircasing to the downside. Now, one break below it does not make a staircase. You need the break and then a new low. Okay? You can't have just one. You have to have the two. These like one downside moves are not a sign of weakness. They're a sign of strength to the upside. Same thing for going up too, in the inverse and regular too. Okay, so just be aware of that today. If the best thing for you, if you don't know how to trade complex trades today, days like today are not for you. You cannot predict this stuff. There's no predicting outcomes on Fed days. Nobody's going to give you a crystal ball that's correct 100% of the time. You can see it right here. We're starting to squeeze higher. You know, this is like just begging, right? Just begging to be trading this. So put this up here. If this wasn't a Fed day, it'd be like, hell yeah, we're out of here. We're going higher. But it being a Fed day, I never trust this stuff. There's just no point in playing. If you want to play, you can. I'll put it up for you here, but it's not for me. Here's our one, by the way. Also note that there's a lot of, let me go back down here, bottom right hand side. Also note that there's a lot of volatility in here. I'll just draw it in. Hold on. There's a gap to be closed up here, but there's a fuck ton right here. I would say the volatility is right about there. 85. Right about there, there's volatility. I'll leave this up for you here. I want to say that is right there. No, hold on a second here. Give me a second here. I got that wrong. One quick second. I want to make sure I got this right. It's 6 p.m. Turn that one red right there.
IDF forces have begun a focused ground operation in Gaza. That's Israel forces are beginning a focused ground operation in Gaza.
It's right where that warning is up there.
The IDF aims to create a partial buffer between North and South Gaza.
Protect your trades from macro headline risk with Financial Juice Pro. Now only $99 a year for our real-time service.
Give me a second here, guys. Take a quick potty break. Give me like 5 minutes. Hold on a second. I got to show you guys here. So my daughter said that my seats were better than the VIP seats. I guess the guy's name is J-Hope. I said his name was Jimin, but his name was J-Hope. Oh, come on. Show me some. Give me a second here. I got to listen to this. Holy shit, this was cool. Oh, you guys with sim cool? Hold on a second here. Hold on, I'll see if I can post in the Discord. So I guess the VIP is to the. Oh yeah, they're like just a few rows behind. Well, I'm listening. Holy shit. They're like right at the fucking front of the stage. That's pretty cool. Ooh, Moog, you taking him down, bro? Are you shorting him? I told them they'll get tied up, man. They'll think it's all bullish. They don't want to believe me. They're roping dope them in, send them packing, make them bleed into the decision. Yeah, fuck no. Don't go long here. It's gonna look so goddamn bullish. There's like a dealer over there just going. Sell them some more calls. I'm gonna dump a bunch of fucking shares in their ass. Look at all these fucking degens gambling. Yeah, that's pretty cool. I mean, I don't know how to do this. Can I download this? Nope, I did that wrong. I don't know how to do this shit. No. How do I save video? I suck at phones. Save video. Okay. Can I go to Discord? Oh, yeah. I guess the VIP was the section just underneath them. And they said they had a better view. The VIP was kind of, I posted it in Discord. I guess the VIP was kind of like you couldn't see, like looking up like that. And this was just one row higher. I think it was like row A, the first row just above VIP. Only 5 minutes. I gotta go potty really quick. Geez, that like. What is that? All right, so hold on. Oh, sorry guys. Let me mute this and unmute this. Gotta go bathroom really quick and then check in with my children. I thought I saw Moog say something about not a large move implicated today. There isn't that big of a move implicated today. Jerome saying earlier, relief rally positive for risk parity equities, and if I could see a bounce as volatility declines. Pain trade, one rate cut. No changes to QT. Yeah, if we got no changes to QT, actually, if we saw this is kind of fascinating. So, Siobhan's saying pain trade is one rate cut, no changes to QT, and that falls into that whole. There's arguments out there right now. I should read some of this shit to you. So, like, I'm reading some of this. Like, the slowing of QT should be for debt ceiling stuff, right? And like, not wanting to have a liquidity crunch. You don't want to hear any talk today from Jerome about so if, let's say this like there's like two or three things let me see if I can bring up an article here. I thought I had it sitting over here, but give me a quick second here. Where is this? Over here? Over here? There's kind of like the Bank of Japan trade versus reality. Hold on a second here. Yeah, pausing QT could put downward pressure on the yield in the 10-year Treasury note, the so-called risk-free rate, galvanizing demand for riskier assets. But here's the other point here. There's another narrative out there that, which is valid, I guess. If you were to get the slowing or pausing QT conversation, you definitely do not want to hear Jerome mention anything about Trump tariffs, inflation risks, risks to economic growth, like stagflationary type situations. And the Fed's projections of SEP could reflect that, nod to stagflation. If indeed, quote, if indeed we get a stagflationary shift in official projections, the market is unlikely to be happy. To some extent, these are starting to be priced in, but confirmation that the Fed is likely to push rate cuts even further out could startle those counting on a liquidity injections. You want to make sure that the Fed is clear as to why they're slowing or pausing QT. You don't want to see it be geared towards White House Trump policy, negative things they're seeing out there, or negative data. So you like today we're taking these projections. You want to see 2 cuts this year, and I would really like them to say like maybe 25, 26 in the verbiage. I'd like to hear that. I don't want to hear like 25. I want to hear like 25, 26, two cuts possibly, because I do think we get that damage late 25, early 26. Or not, I don't think we get it. There's a likelihood that we get damage. You got to figure that if we're to take Trump not seriously, but literally, that he only has 2 years. That's all he's got. I said that earlier in this program about the number of people that actually voted for Trump was not that high. And not all Trump supporters are happy right now. You cannot say that they are. They are not. And they are not. The loudest voice on social media might be saying that, but that's not the case. And then on top of all that, there's still insecurity from people that are for it, even if they won't tell you, even if they're not going to make that known publicly. So, if Wall Street takes them seriously, and if they are serious in trying to do that, they only have a small amount of time. It grows more likely and more likely as just days, not even months, just days pass, that there is going to be a fight to tie him in. Either, and I'm not even saying that's Democrats. I would suspect that Wall Street will make this attempt as well. But if he tries to circumvent and do that damage, like he's been trying, let's admit that, right? That's what he's doing. Trying to do permanent damage to the bureaucracy, right or wrong or whatever. I don't care. I don't care about the politics of it at all. What I do care about, though, is the effect on the economy, on data. And he's only got so much time. So he would attempt, I would assume, to ram that home as fast as he possibly can. And I was actually reading a story last night from an insider from SCOTUS, and in this article there was 2 or 3 people that were quoted in this article. One of them works in DC, and they were talking about how the damage that's being done to our bureaucracy, one way or another, will need to be revamped again the moment there's a regime change. So you're talking about effects that are right tail risk that's not positive. From the left tail, we could see damage down the road in time, and then this doesn't even clear up China. Like there's still this like large elephant in the room down the road. Did you guys all see the landing craft and bridges that China finally finished? It was like new. I posted on Twitter like 2 months ago, and then this past week or last week there were pictures of these landing craft finished. These weren't landing craft like for war; they were for the end of war, right? These weren't things that you're going to land on a beach. They'd be a target-rich environment, right? They're kind of goofy looking. They were unique. It was almost like a semi-permanent boat dock of a kind, and not a temporary dock, but like a semi-permanent boat dock. You know, when a country builds shit like that and they start testing them, they mean business, don't they? They mean fucking business. You've got them on display. They're telling you right away, we are doing this, whether you like it or not. So even that looms down the road. And not only that, in a brief last night that I wrote, I talked about the summertime. So let's say we blast down and then go higher into midsummer, or let's say we just turn here and go higher. Or like we could, like I could give you three scenarios. We blast down here, right? And then ricochet up. We have like that, what's his name here from this morning? Pravorsky is saying, we think the rally is done. So let's do a mental exercise of this, right? So Pravorsky's like, I think the bounce is done. So let's go with what he says. The bounce is done. This is all you're getting. We're going to jackknife to the downside. Okay, let's say we squeeze here too instead. Squeeze up a little bit. We trade 82.04. I don't care. Say 82.04. I don't give a fuck. I don't give a fuck if we squeeze up there, then roll down. I don't give a fuck if we jackknife down right now. You know it's going to end by mid-April at the latest on single stock issues, and then maybe April 30th on indexes. So you get another ramp to the upside, like ramp, summer trade. And everybody forgets this. You know how this goes, right? Whole fucking market forgets all about this, literally. We're up there in the middle of July, and you got all the bulls now screaming, woo, we're only going to keep going higher, bro. Right? Same situation on the inverse. But we're not out of the woods yet either with the EU or NATO. We've got meetings in Belgium starting, or they're ongoing right now, and they'll become rampy. And you've got USMCA, both, like all that shit starts up. Like USMCA, I think, is June, July. You get a whole bunch of wrap-up meetings with NATO, the EU. So you have a whole nother round of Trump, like aggressively no Trump put. And I'm sure that shit's going to get ramped on the docket. Even if we have a relief rally, even if we jackknife down and go all the way back up again, you still have unresolved volatility in the midterm. So you get that like far out volatility in danger, right? 26, 27 with China, whether it's a cold or hot war. And then you've also got midsummer volatility. It's on tap, ready to rock. And then you've got tails from all this stuff. What is the damage that's done from tariffs, reciprocal tariffs? And to boot, on April 2nd, we have reciprocal tariffs. Now, Trump's trying to put the Trump put out on this stuff right now. We're working on it. We're working on it to resolve it. You guys already know that Trump likes to create problems and then solve them. He literally creates problems, and then he wants to solve them and claim that he did the thing. I fixed this. Yeah, but you broke it, bro. Yeah, but I fixed it. So I gotta need the credit for fixing something. Not shitting you. That guy is vain. Even if you like him, you can't tell me that guy is not petty, not vain, and wants the credit for something that he already created.
Says he just completed a call with President Zelensky.
You know, I was looking.
Just waiting for any details of this to come through now.
Hold on, let's see if we got anything here.
Says the call lasted about an hour. Says the.
Do you want to stay up to date?
Hold on a second here.
And be on the bleeding edge of news for non-farm payrolls? Then sign up today and get
Are you serious with a fucking ad?
Pro for
Hold on here.
Worth of our service for the price of 1 month and save 92%.
Fucking ad, right? When you're supposed to be dropping this stuff. He just completed a call with President Zelensky.
This is in a Truth Social post. He says much of the discussion was based on the call made yesterday with Putin.
I'm reading his Truth Social right now. Just completed a telephone call with Zelensky of Ukraine. It lasted approximately 1 hour. Much of the discussion was based on the call made yesterday with President Putin in order to align both Russia and Ukraine in terms of their requests and needs. We are very much on track.
Trump says we are very much on track. So again, Trump.
And I will ask Secretary of State Marco Rubio and National Security Advisor Michael Waltz to give an accurate description of the points discussed. That statement will be put out shortly.
Trump says, I'll ask Secretary Rubio and National Security Advisor Waltz to give an accurate description of the points discussed.
Trump on Zelensky, we're very much on track. Says that there'll be a written release on the discussion. But I got more here for you. This is something else that isn't discussed. The debt ceiling, right? It's like it's here and then it's not here. There's like we have a whole nother debt ceiling discussion coming up. Trump wants to get rid of the debt ceiling, right? And this will be likely a pertinent question today in this FOMC. And there could be some, it's not, or in the projected path, right, for inflation, there's a whole nother topic, right? But on this debt ceiling, we are fighting right now with other countries, right? We're fighting right now with Canada, Mexico, Panama, I don't know, Colombia, China, all of Europe. Who else? I don't even know who else who I've named and not named. I think Japan to some extent, even though we haven't been talking about that recently. I think I got these targets right. Maybe it is higher. I don't think so. I think that's right. I think I have this right. So you're looking for a new high here, by the way, on that yellow bar. Here's something that no one talks about. You don't hear about this in the news anywhere. So this is the topic of ballooning U.S. government debt. Like, I was trying to wrap my head around the debt. So I go down the rabbit hole and I'm like looking what Doge is saying they're going to do, or claiming they're going to do, or claiming is going on. And then I'm looking at tariffs and I'm looking at taxes and like the reality of all of this stuff versus our debt. And they're not balancing shit. They ain't balancing that fucking budget this year, fucking next year. That ain't happening. I don't give a fuck what they're telling you out there. That shit ain't happening. But here's a question for you. Let me ask you a question. Now, this debt continues to climb, right? And the interest continues to like compound. Who's holding that debt? Let me ask you that question. Who's holding that fucking debt? Take a wild guess. All these countries we're fighting with, a whole bunch of it. So who holds the ballooning U.S. government debt even as the Fed and foreign holders unloaded Treasury securities in Q4? Now, is it important today? No, but it's going to become important. I assure you, at some point, all of you out there are going to, in one weekend, become certified government debt foreign holder of Treasury security holder professors at some point. As soon as it's in the news, you guys are going to all become, weekend analysts on this stuff. And now this doesn't matter now, but when does it matter? If we, as a country, self send ourselves into a recession, right? I mean, literally, from just sentiment, we create the recession. Remember, there isn't rampant unemployment. There isn't rampant, persistent, Fed term, inflation. There's money in the market. There's money in the economy. They're fucking printing money for you right now. They print it to the banks, hedge funds, and you. Even if you don't believe that, they do. But we're not tightening, right, the money supply on you.
The understanding of DeepSeek R1 is completely wrong.
So if you create your own recession, let's say we do, right, as Americans, we have Trump policy, all that kind of stuff, we create that recession, right? Who holds our debt?
And the NVIDIA CEO says demand for computing remains extremely high.
When the incredibly ballooning U.S. national debt reached $36.22 trillion in January.
Increases computing demand.
It hit the debt ceiling, right? You remember that? We hit the debt ceiling. That's when Trump comes out and he says, I want to get rid of the debt ceiling, with which Congress prevents the government from borrowing the money needed to spend the money Congress told it to spend. In the past, just before the government ran out of cash, Congress makes a deal with itself to raise the debt ceiling, upon which the debt spikes by hundreds of billions of dollars in just a few days as the government borrows huge amounts to refill its checking account. The flat parts followed by spikes. Hold on one second here. In this chart right here, let's go look at it really quick. You see this right here? These are the flat parts right here. Flat part right there. Flat part right there. Flat part right there. Flat part right there. Flat part. Flat part. The flat parts followed by spikes in the chart reflect that dynamic. These are treasury securities that private and public entities in the U.S. and across the world hold as interest-earning assets. The question is, who holds this debt? Who has been buying it? So who held that debt at the end of Q4? First was U.S. government entities. They held $7.3 trillion. These intergovernmental holdings consist of treasury securities held by various federal civilian pension funds. Think about that if we go into recession. I want you to think about who's holding this stuff if we send ourselves into a recession. They're held by federal civilian pension funds, military pension funds, the Social Security Trust Fund, the Disability Insurance Trust Fund, the Medicare Trust Funds, and other trust funds. These are securities that are not traded in the market. The public, quote unquote, held the remaining $28.83 trillion. It's almost 4 times that amount in treasury securities at the end of Q4. 4 times. Most of these securities are publicly traded and their holders are spread around the U.S. and the rest of the world. Keep on squeezing. So who is the public that holds these bonds? 30.2% are foreign holders. So 4 times as much, 30% of that is by foreign holders. Foreign entities held 8.35 trillion, or 30.2% of publicly traded debt at the end of Q4. These holders include foreign private sector entities at 4.73 trillion, foreign official entities such as central banks 3.78 trillion. The ratio of T-bills to total foreign holdings has been between 12.1 and 14.6% since mid-2020. Before the pandemic, it was in the 10% range. But they did shed securities. Foreign entities have shed 166 billion of treasury securities in Q4, or 1.9% from the record in Q3, 8.6 trillion led by, guess who? Top financial centers, 6 of them, including London, Belgium, Luxembourg, Switzerland, Cayman Islands, and Ireland, for 60 billion. 36 billion to Japan, 33 billion to Brazil, 28 billion to India, and 12 billion to Europe, or Euro area. But other countries added to their holdings over these 3 months, including Canada, the 54th state. They added $11 billion. They own our debt. The biggest foreign holders, right, are the top 6 financial centers at 2.56 trillion, the Euro area at 1.79 trillion, Japan and China and Hong Kong combined with 1.1 trillion. China actually holds some of the least debt. We have more to go here. The warning is actually probably higher, like right here. I might have this wrong here. There's more room to run here. Well, you want to watch this one down here more closely. Right here. The top 6 financial centers include U.S. corporate holdings, 2.56 trillion, down by 60 billion from September. U.S. corporations hold a portion of these treasury securities to park their overseas profits overseas, as to not have them taxed in the U.S. We know this, right? Ireland and Apple were a big example of that, as a Senate investigation in 2013 revealed. Jeez, I think I was in the market then because I remember that shit. More uppies to go here. Canada has emerged as a large buyer since the pandemic, more than tripling its holdings over the past 3 years to 379 billion. 1, 2, 3, 4, 5. 2, 3, 4, 5. Let's go 1, 2, and 3. The scarier part is that holders in the U.S. are 69.8% of this public. U.S. mutual funds hold 19.3%, or about 5.5 trillion of the debt held by the public. This includes bond mutual funds and money market mutual funds, according to quarterly fixed income report for Q4 from SIFMA. Money market funds alone held 3 trillion in Treasury securities, including $2.4 trillion in T-bills. Money market funds added $335 billion in Treasuries in Q4. Amid overall surge in money market fund balances, Fed Reserve has 15.2%, or $4.29 trillion of the debt held by the public as of the end of Q4. Under its QT program, the Fed shed $93 billion in Treasuries in Q4. Since mid-2022, it has shed $1.53 trillion in Treasuries and $2 trillion in total. And that was as of the March Fed balance sheet. I want to show you a simple chart here. Talking about earlier, or when we were discussing earlier, panic in the markets in 2019. Fairly simple, right? You got to slow this down, right? Slow it down. You start breaking down here and you start to cause panic. This is the repo market blowout panic that took place here in late 2019. The Fed stepped in too late, right? Instead of stepping in before we get there. This helps to stabilize markets. Three right there. Right there. U.S. households and nonprofit organizations hold about 9.5% or $2.68 trillion of the debt held by the public at the end of Q4, per Federal Reserve data. These investors who hold treasuries in their accounts in the U.S., but they shed $229 billion in Q4. U.S. commercial banks own 6.2% or $1.77 trillion of the debt held by the public at the end of Q4, per Federal Reserve data, and added $33 billion in Q4. These banks include U.S. chartered commercial banks with $1.54 trillion, foreign banking offices in the U.S. with $100 billion. Credit unions hold $63 billion, And banks in U.S. affiliated areas hold $23 billion. Treasury securities held by banks, pretty good size there, right? 6.2%. U.S. state and local governments, including pension funds, own 7.3%, or $2.07 trillion of the debt held by the public. They reduced their holdings by $28 billion in Q4. 12 o'clock right now. Could you guys do me a favor out there? This is one of the larger days for us here. We usually get some of our largest audience on Fed rate days. You guys mind doing me a solid and hitting the like button if you could, or subscribe, or if you're watching on Twitch, if you could go to or YouTube and hit the like and subscribe. Even if you're watching on Twitch, or if you're on YouTube, go to Twitch and do the same thing. It really does help the channel grow naturally. I don't buy any followers or watchers. I don't pay for fake viewers. I don't pay for fake likes and any of that kind of stuff. So I appreciate if you could help me out there. It being 12 o'clock heading into the start of today. Or maybe even just, if you don't want to do that, if you could repost the stream on your favorite social media, I'd appreciate it. Thank you very much. U.S. insurance companies held about 2.3%. Not too much. Of course, they're risk adverse. $650 billion of the debt. But you can see this all adds up, right? All of this stuff adds up. Exchange traded funds hold a little bit. Private pension funds hold a little bit. U.S. security brokers and dealers hold a little bit. Like 2%, 1.6, and 1.4 respectively. There is some good news here, though. I've shown you guys in the past the U.S. Debt to GDP ratio, and that has flattened. There was panic about that, I want to say, 2 or 3 months ago, and we came down from a high at 130% back down to 110%. Not as risky as was once forecasted with the party time in the elections. And even if we get a hit to GDP with tariffs, it's expected that it's a one-time hit, not persistent. We already know that if we front-ran a bunch of tariffs beginning in November, December of last year, of course, these companies are going to try to pass it along to you twice. They're going to try to double dip you with these tariffs. It's your job as a consumer to say, fuck you, no. And take that hit. And what's crazy, too, is that these corporations won't take a hit. That's the most fascinating part. In their next quarter returns, right, when we go into this next earnings season, outside of, I would say, restaurants, all these guys have been jacking you up for 4 months with no tariffs. It's been pure profit. Pure profit. They haven't even realized these tariffs until just now. And they're going to cry to you, tell you, oh, woe is me, as they're raising prices yet again. And it's already showing right now that consumers are saying no, especially in restaurants in particular. I mean, I'm with you. I mean, like taking off the trader hat. It really, I mean, let me give you the idea. This is where it gets, I've told this story before, but let me explain this to you again. Because so many people get this wrong. Or it's astroturfed so that you get it wrong. So, and I don't know why this is. I don't understand it at all. I can't wrap my head around. My assumption here is that it's because corporations own newspapers. They own news organizations. They own social fucking media. They literally feed you garbage. They feed you garbage if you're a Republican. They fucking feed you garbage if you're a Democrat. Garbage. Like fed to you. So let me explain this simply for you. I think I've done this before, but I'm going to use a different way to, I know the way to do it, but the best way that I've got here is a story I read in Chicago. There's a brewer. I was at Au Cheval eating fucking burgers. I was at Au Cheval. Matter of fact, that was just a Barron's article. If any of you were there eating fucking burgers at what's considered the best burger joint in the U.S., and drinking Rip Van Winkle with me in PBRs as we almost got kicked out. As a matter of fact, Barron's just did a fucking article on Au Cheval on tariffs. I was like, oh, we were just there. We almost got the boot. That was some funny shit. Like the host came jumping over the table. And then the fucking waiter was like, leave those fucks alone. They're spending more money than the whole restaurant. True story. So I'm in Chicago, and they got an article. This guy's a brewer. And I want to like simply explain this to you. I'm going to take off my Wall Street hat right now. I'm going to put on my consumer hat. This should anger you no matter what your politics are. Listen here closely, because I know a lot of you. So in my career, I want you to know what my job was in my career. I don't talk about this a lot recently because of the environment out there. My profession was I would go to your company and fire you. That's what I would do. A company would say, I want to be the best, and I'm being lied to, or the bureaucracy in the company's killing me, or they maybe promises, or I don't know the right ratio of this and that to be the best. And I don't mean the best like
$9 a year for our
I don't know, top 100. I mean like top fucking 10, top 5, top 3, and in one case, top 1. And so my job was to come in and tell you what they were doing wrong. I was the bad guy. My whole job was meant for me to get fired or let go, to replace me with someone that's going to carry on that corporate culture. I'm meant to be the bad guy. Not anymore. That was my job. So I would sit in C-suites. These fucking people are like, there's a whole culture behind this. You go to school for this. There are kids, families, wives, children, multi-generational that grow up in CEO culture. I'm not talking about startup CEOs or inventors or anything. I'm talking about CEO that runs a company. It's a professional class of people. These people are fucking sociopaths. They are literal functional sociopaths. These people would be like murderers. They would be like a Ted fucking Bundy if they weren't putting their mental health issues to work in corporate America. They are evil. And I gotta tell you that. And no matter what face they put on to the Rotary Club or your local golf club or whatever, behind closed doors, they're vicious. And they will do anything for profit. Above all else, they will try every avenue to pass along cost to you, the consumer, no matter what. any way, shape, or form. Some of it's time. Sometimes it's laziness. Sometimes it's this or that or whatever. It's so bizarre when you're sitting in that office and you go, Jesus Christ, that guy has a completely different persona to every group of people I see him meet. And then once you're alone inside the dungeon with him, the fucking mask comes off. And I'm not lying about that. It's fucking crazy. And as a regular worker, you have no real true understanding of that. You think you do, or you think about it from time to time, or you topically think about it, but you've never quite seen it. Not in person. When that mask comes off, it's like, rah! Right there. You're like, oh shit, there it is, the monster. As a profession. So this guy's a brewer. He's in Chicago. There's an article about this, came out, I don't know, a month ago or so. And he's like, I make beer. He's like, and my fellow brewers and I buy beer cans from an aluminum producer in Canada. He goes, and there's tariffs coming. They're tariffing us. I looked this guy up. He was raising his prices in November. This guy put a song and dance out there. He was like, oh, the aluminum prices, they're going up. His aluminum prices hadn't gone up. He'd already began raising as inflation was rising last year. He was raising his prices with inflation. And then he raised his beer prices. Like his beers were like up 25%. And then he was talking about reciprocal tariffs and how he might have to raise it even more. He might not even be able to stay in business. And he was doing a plea through a newspaper to you, the consumer, so that you would understand. Watch out here. Let me watch this. We might be rolling here.
NVIDIA CEO says, I am confident that margins will improve.
Careful here. Danger. Not quite yet, but. We lose this, it's party time. Now, look at this. I want to understand this. This guy's raising prices. He's begging you to absorb those prices. He's raising the price of the beer he sells you 25 fucking percent. And he's telling you he might have to raise it another 25 on you. A beer. A fucking beer. At that point, there was no tariffs. Didn't matter. And he's talking about raising them again. He'd already been raising his prices in November. And then he's telling you he's going to raise them again for the 25%. Not even the reciprocal yet. Like, I'm going to have to raise another 25% here. I'm dealing with inflation. Now I'm dealing with tariffs. See how quick I lied to you? You see how quick I lied to you? I'm dealing with inflation. I'm dealing with tariffs. That's not true. Tariffs are being priced in early. He's going to get you twice. This guy's not losing money. Then this guy says this. I was shocked. I'm reading the article, and the guy says, I'm going to have to raise my prices again 25%. And I go, wait a minute here. Is an aluminum can all aluminum? The can probably has some other metals in it. Then there's a paint job on it or a sticker or something. That's going to cost something. Then there's cost in the manufacture of that can. You understand? Making the fucking can is not aluminum. And then if his beer, let's say, costs $1, and he raises it 25 cents, that fucking aluminum in that fucking can is not 25 cents of $1. It's probably like 5 cents. So maybe he eats the 5 cents. Nope, he passes along 25 to you. He fucking pocketed 20 fucking cents on your ass. And then he's talking about doing it to you again and again if there's reciprocal tariffs. And he's scared that he may go out of business because you won't pay that amount of money. This fucking guy did not mention eating some of that profit. That guy didn't mention seeking out alternate suppliers for beer cans. That fucking guy might even do that and not even tell you. That guy is there to make money. And all he sees tariffs as at this point is, what can I pass along to you, the consumer? I might be more profitable after these tariffs. Is he going to tell you that fucking publicly? Fuck no. And you as the consumer are out there on the internet defending these companies. Mind blown. It's going to send us into a recession. It's bad for business. Bad for business? You're out of your fucking mind. It's not bad for business. You haven't even told them fuck you no yet. You haven't even told these companies, I ain't buying that shit. No. You eat some of that profit. And this is just a small beer producer. He doesn't have an army of economists working for him. I'm serious. There are companies that have educated people saying, how much can we pass along? Give me any opportunity to pass along cost. Give me any opportunity to get more profit. How much are they willing to pay? Let's push them. Yeah, we'll try to find a new supplier, but I got more for you. McDonald's. I want you to look at their value menu from last year. They had like a value menu that everyone was upset with. Their CEO came out in their last ER and said, we're going to launch a new value menu. He literally lied to you. I don't know what it was, but it was, let's say it was a burger and a pack of fries for $2. Right now they're giving you like 2 burgers, no fries for like $4. Something insane like that. So he's like praising this. Hey, I got a new value menu. We listened to you. And some of you bought it. You never went to check what the old value menu was. Like literally. None of these companies care about you. They will do anything and everything at every moment that they're given a chance to make more profit off of you. There has to be a point where you, the consumer, contact these companies or tell them, write them an email, or just stop buying. I refuse. No. I'm serious. I know. It's like one lie after another lie after another lie, using tariffs as the boogeyman. Here, I got a better one for you. There was a post on Reddit about I think it's in Canada. There was a post on Reddit about some famous ice cream. It's an ice cream shop. The famous Canadian ice cream shop that said, we're not going to raise prices anymore on you. If you go look at the data that came out on Canadian CPI this week, they've been cranking prices in Canada. Cranking. Inflation's raging in Canada. They're passing that shit along to the consumer, right? Until you say no. And there's good news here. There is some good news. Historically, after all this astroturfing happens, you are going to wake up and you're going to say, no, I ain't doing this. And they will eat that profit loss, or they will change suppliers, or they'll lie to you. You know what shrinkflation is, right? You know when a product tastes different. I remember when this thing tasted a lot better than it does today. Why is it smaller than it once was? Why is the bag larger and there's not as much in it anymore? Why do my jeans last shorter than they used to last? Why is the t-shirt on my back getting stained permanently the first time that I wear it? I went to wash it. Why is the shit peeling off my clothes? You get what I'm saying? So one way or another, they either lie to you. You know what I mean? There's like no out for you. So if there's anybody to be enraged at, who is it? Ultimately, who is it? It's the company. It's not like policy. It's the company. That's who it is. Or you demand better. We saw that last year. We saw consumers stop shopping at McDonald's about a year ago, and they started shopping where? At other alternatives, right? You could go from eating at McDonald's and sit down at a fast casual sit-down restaurant and pay the same amount of money that you would for eating at McDonald's. Even if it's not quality food, but you could go sit in like an Applebee's or whatever those, like, I don't know, Olive Garden or whatever, like that brand of like fast casual sit down. You could sit in there and get the same meal. You couldn't do that 5 years ago, or more than 5. I'm getting old now. Pre-COVID. Oh, these fucking bears want some revenge, don't they? Think about that brewer. Have another opportunity to raise prices. And I'll tell them anything they want to hear. It's the big bad government. And in fact, they are doing what? Committing greed. Your local beer producer is not demanding from his beer can producer to be charged the tariff, is he? Think about that. I own a beer company. I have to raise prices on you because of tariffs. First thing I should do, if I have ethics, is go to my beer can producer and say what? I understand we have tariffs coming up. The beer can was costing me 5 cents. Why is it now, I don't know, an extra 2.5 cents? Or in this case, about $1 or a point, I don't know, it's like a penny and a half, penny and a quarter or something like that. Why not go to that beer can producer and say, hey, you can absorb these costs of tariffs, right? Or charge me what the tariffs are, and I'll pass that along to my beer buyer. I understand you can't eat that for your profit. Let me just pass along a few pennies. Instead, it's not like that, is it? They're as shameful as the person who's doing the tariffs that you don't like. It's an equal opportunity fuck the consumer, for lack of a better word. At least for a period of time. The good news is that historically, that shit doesn't fly forever. Historically, as the race from everybody to hit you with that inflation, you will turn to other products or services. You'll get smart to it. And then they'll race over there and try to hit you wherever you are buying. You'll change your behaviors. Usually, not all the time, but usually you will. Still holding on. I find that fascinating. Come on, sell it down. Try to help the Bears out here. It's crazy. Absolutely crazy. Yeah, they did pull back their restaurant and bar sales. They have not, though, pulled back elsewhere, have they? It's actually cheaper for the consumer and other. It's like, all right, so hold on a second. What did I just read? U.S. consumers are pulling back spending on dining. I agree with that. But tell them the rest of that story, too. Tell them about how they have cheaper costs elsewhere. Tell them how gas has come down cheaper. Tell them. You got to tell them the full story. The consumer does say, no, I'm not going to buy this, right? I'm not doing that. They also, though, have cheaper goods and services elsewhere, too. So they're in good shape, aren't they? The consumer is still in good shape. For now. For now, they are. We don't want to see a pattern of that, do we? Go back on your own and watch or not watch, listen to the McDonald's I think it was Q4 or 3 of 2024. Go back on your own. I already listened to it myself. You go back and you listen to it.
Again, Iran must stop sending Houthis supplies immediately.
When they announced the new value meal. I'm not listening to it again. I'm not Googling it for you. You do it. I can ask so many questions in a day. I can't.
Stay up to date with the latest.
I can't. Literally can't.
For non-farm payrolls, then sign up today and get our special offer.
If I was just hunt down answering like shit like that, I wouldn't get anything done.
Save 92%.
I can't sit here and tell you stories. All right, give me one quick second here. I gotta take one more quick break. When I get back, it's 12:29. We have an hour and a half until the Fed decision. It's actually more than just the Fed decision. We're gonna get a rate decision. The markets, all markets, are looking for some commentary on QT, a slowing or pausing, and also the reasoning for it. Is it ascribed to debt ceiling stuff, which makes sense, and all the stuff I told you this morning? Or is it going to be ascribed to danger with inflation or danger with policy, which has been pumped on social media? We're also getting interest rate projections, first year and second year, 25, 26. You do want to hear 1 to 2 cuts in the next 1 to 2 years. And also an interest rate projection currently. You're also going to get an interest rate projection for longer. Then you get a presser at 2:30. We will have the presser live. And when I get back, I'm going to talk to you about 5 numbers and probably I'm going to go over the verbiage again because there is some specific verbiage about QT you want to listen to. Supple, robust. Sorry, I'm being sarcastic right now. And you also want to hear about, I don't know about, I hate the dot plot. It's more gambling than anything, but we'll go over some of the key points you're looking for. You can write these things down, and when the Fed chair is speaking, you can be like, oh, he said this, or he didn't say that, or I needed him to say this, or I didn't want to hear him say that. And we also want to know if Jerome's been defanged. Oh, they're really fighting this here, aren't they? Let me just check this really quick. They might have lost this. I think they might have lost that 5 minute. No, they are fucking trying right now. Downside targets, 563.97. Here's the 15 minutes, still good, but the target is much lower, 563. And here's a 4 hour right here for you. Still not there yet. They're holding the 5, and the 15 is like right here. They're still building out this island right now. If they lose this island, target 563.38. Another note too: we have not backtested the hour and half hour HT. We launched off it, but we still will always, not always, most of the time, come back here and retest this. And the half hour trigger is crossing the hourly trigger right now. Perfect time to drop this shit. I'll be back with you in about 5 minutes. I have 5 minutes. I'll be back with you guys. I'll be right back.
So according to Axios, Abu Dhabi-based wealth fund ADQ and US heavyweight energy capital partners aim to invest over $25 billion in projects to power data centers. Nvidia repeating that tariffs will have little impact in the short term. Nvidia says long term will shift manufacturing onshore.
Protect your trades from macro headline risk with Financial Juice Pro. Now only $99 a year for our real-time service. Let's keep in mind at the top of the hour, do get the daily press briefing at the White House with White House Press Secretary Leavitt. We will be posting the video out for this once it is available, since there may be some details of the Trump and Zelensky call mentioned in this press briefing. So again, that's coming at the top of the hour. We'll keep you posted with anything that comes through.
According to Axios, Trump gave Iran a 2-month deadline for a nuclear deal in a letter.
Just a note that there is a bear plane forming on the 1 and 5 minute trigger here.
Shortly expecting the Federal Reserve reprobation data. $47 counterparties take $193.78 billion at the Federal Reserve reprobation.
Levitt says Putin and Trump agreed the need for lasting peace.
Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month and save 92%.
All right, hold on a second here. Oh, look at that rug over there. Bear's just watching that rug. Ooh. Staring over the abyss. What do I got? I got a guy named Gerald. If you're out there, thank you very much for thank you very much for getting me the link. If you're out there watching. What else do I have to do here? One quick thing. What am I looking at here? Okay, main screen. Get rid of that. Get rid of that. We've got a half an hour until we begin here. Yeah, that's what I was looking for. I was inside the pro chat talking to them earlier about this blood. There we go. We're discussing the blood here at 2 p.m. Rain and blood. Hallelujah, rain and blood. Oh, yeah. Close the gap. Um, Dude, I got some really funky shit going on in my Discord. I can't see shit. I'm getting like messages that I have unread messages, but I don't. I don't know what the fuck is going on for me in Discord. Hang tighter. We got some stuff to go over here. I'll give you a quick preview here as we get ready for the presser at 1:30. I want to give you guys if this is your first time watching the show, welcome. Good to have you here. We love doing the FOMCs. We usually have a pretty good record with here on these days for some reason. As you know, I go down the rabbit hole in this shit. Hopefully you guys, a few primer things here. If you've been here now for a while, if you've been following, I want to give a big, now, number one, I am not friends with Wolf Richter. I don't know him. I communicated with him briefly a couple times via email. I hope to have him on the show one day if he'll ever have us. I don't think that he will. But if he ever did, we'll have him on. And I'd really like to have him on because this guy, I got to promote this guy, even though I don't know this guy at all. But I would ask you to start reading that guy's blog regularly. I would ask you to not comment.
So then,
unless you know what the fuck you're talking about. He's going to throttle you. Especially if you want to bounce off the regurgitated shit you read on FinTwit, go ahead, be my guest. You're gonna learn. But you should read that guy's blog because if you stay consistently reading that guy's blog, you are going to. Let me just mute this for a minute here. You are going to
disconnected.
Learn about Fed speak, and Fed speak is important. The more you read that guy's blog, the more you understand things that Jerome is saying without saying, which is very important. The one thing, if there was one thing I learned from Wolf Richter, it's when Jerome says something, you go like, I know exactly what that guy's saying. I know exactly what he means now. And it's very enlightening. So if you ever have the chance to check him out, Wolf Richter, it's called Wolf Street, his blog. I've been reading his books and stuff. Guy's fascinating guy. He's like kind of like a Bukowski or a Hemingway or whatever of the stock market world, and he's very smart as well. He's had a very wild and tragic life too. Even if you don't understand that stuff, you just read it over and over and over and over and over. You'll start to understand. He demystifies a lot about this kind of stuff. And what it really means. Now, that doesn't mean you don't trade the market against what's being peddled towards you. It's just that you have an awareness of what's really true and what's not. So I'm going to pump that guy up. If you have the chance, read his blog consistently. Even if you don't understand, if you don't get it, and make sure you're like reading the commentary. I usually read the comments, then I go back and read them again in a few days as the commentary builds for the discussion. There are some very, very smart. If you want to talk about a collection of smart people reading that blog, if you read those comment sections when they fill up with like 100, 200 comments, some very, very intelligent people in there. Very wise investors, traders, professionals, and they simplify something that's can be very mystifying. They demystify a lot of things that can be very demystifying. So I'll leave you with that. There are some key words you are looking for today. And I want to discuss that with you today if we possibly can, or before we get to this presser at 2 p.m. I hope I have enough time to go over some of this stuff with you. Give me just one quick second here. Hope I have enough time to go through some of this stuff. Just one quick, or some quick stuff here. Hold on. A few points. Now, the market will undoubtedly move on today's fresh round of forecasts and dot plot from the FOMC. Some of the key things you're going to be looking for from the Fed or from Jerome today is GDP for 2025. In December, the median bumped up to 2.1% from 2.0% for this year's growth. Given that the Atlanta Fed GDP now forecast is well below zero, it's a good bet to forecast this will dip. Also watch for the range, which is currently 1.6 to 2.5. If you read Wolf Richter, he talks about seasonal adjustments in GDP, and he also talks about having a seasonally bad number mixed in with normalcy and normal numbers. You want to see if Jerome speaks about that, about GDP today. Second would be 2025 PCE inflation. In December, the PCE inflation forecast rose to 2.5% from 2.1%. And you'd expect that to continue to rise. The consensus is now at 2.9%, which was the top end of the range in the prior forecast. It is subject to considerable uncertainty and may be boosted by one-off factors on tariffs and that officials will look through. Now, I want you to think about that too. You want to look for words like persistent. If Jerome starts to discuss inflation, is it transitory, persistent, or is it something that they expect short-term bills to deal with? When you look at inflation, right, I want to talk to you briefly about inflation before Jerome starts to speak. You never want to see velocity in inflation. That's always bad. Up or down, bad, always bad. You're always looking for inflation to, let's say you have a rise in inflation, but it's no velocity in it. You're looking for that inflation to dissipate, right, or to not remain persistent, especially with tariffs. If you see velocity, that's bad, right? Velocity is bad, and then also persistent inflation looks like this. It's not negative like this, but it's persistent. Readings. You want to hear that the Fed is looking towards tariffs and short-term bills to make sure or to ensure that inflation is transitory, that it does not remain persistent, and then also you don't want to see persistent inflation stick around like this either. Even if it's not like 4 or 3%, you don't want to see that rise over time. That's also bad too. You'd see more rate hikes in the future. Normally, in the long duration bonds look good right now for dealing with this. Right now, the bond market is allowing more data for inflation. So 3 to 6 months. Especially with these odd months thrown in where you get a bad read. GDP Now did that. GDP Now actually gave us a really bad read on GDP, but you need more data in GDP Now. And think about the same way with inflation. Every trader wants to front run like tariffs bad. Historically, it's not bad. If you look on inflation data from Trump 1.0, that inflation that we incurred was a one-time hit. And I want you to remember that. One-time hit to inflation, one-time hit to GDP. And looking for that data to be right or wrong after a period of time. Does it become persistent, sticky, any of that kind of stuff? Does it rage out of control? And if Jerome discusses that stuff. Also, the unemployment rate in February non-farm payrolls report was 4.1% compared to 4.0 expected. That adds some downside risk to unemployment rate forecasts, which sits at 4.3 for 2025, 2026, 2027. Now, another point here on the unemployment rate. You want to see Jerome dispel right now that the laying off of government employees or the significance of government employees on the unemployment rate is minutia. It's used in social media and media to fan the flames of doom. But in reality, 20,000, 40,000, 60,000, believe it or not, jobs canceled, not that bad. They did try to play it off like, I think Besant tried to play it off like, well, they'll be hired by the private sector. That doesn't really matter. You need way more layoffs. you need like millions of people to begin losing their jobs for this tiny news, or this large news this large news story to be larger in data points, I guess, for lack of a better word, how to describe that. The dot plot. I'm not really a fan of the dot plot, but the median dot for this year is 3.9%, and there is a strong cluster around that. It compares to market pricing, which is at 3.77. It always the curve also always prices in some level of black swan risk. Further, the Fed might signal more caution around rate cuts from 3.4% in 2026 and 3.1% in 2027. And that's that further down the line stuff, because we do have today we do have interest rate projections, longer current first and second year, coming out with the Fed rate decision today. In terms of that right here. In terms of QT, one quick second here. In terms of QT, so I'll make sure I got this right, that I'm not fucking any of this up. You want to make sure that the discussion sticks with debt ceiling talk and not risk to markets or any kind of risk from the economy or presidential policy other than debt ceiling. You want to remain on. You want to see Jerome remain on that debt ceiling discussion. You'll see reporters attempt to goad him into discussion as to White House policy or economic conditions. If he does venture into that negatively, that is bad today for the market. You also want to hear him discuss. You want to hear like supple or ample terms like that. Abundant would be another word. So if you hear any of those kind of words, we'll see what he has to say if we're in abundant or if we're near ample yet. Because I think we're at abundant the last time he discussed this. And as soon as if he says like we're near ample or anything like that, that's kind of positive in a way, or should be perceived as positive. Also, watch Bitcoin today and its reaction to the Fed. Watch Bitcoin and currencies in particular with this rate decision and some of these forecasts. They could give you some insight as to if we're going to go risk on or not. Is the bond market happy with removing some of the volatility with QT so we don't get a shock in the future? Basically, the checkbook the bank uses, the Federal Reserve Bank uses, has plenty of cash in it. What else do we got here for you? Give me one quick second. A couple more things. JPM's Michelle saying Fed is in a tough spot when looking at inflation. Oh, God. That's like nightmare fuel reading that stuff. Give me a second here. I'm going to set up the stream for 2 p.m. so we can watch some of this stuff together. Give me just a few minutes here. Rate decision. All right, what do we got going on here? Sorry about all this hecticness here. I'm going to shuffle some of this stuff. I'm going to make that a little bit smaller. Raise that up a little bit. I'm going to bring up, where's this one right here? Tap center screen. Right there. Done. I might have to bring this over a little bit. Tight here. Does that work? Hold on. No, hold on here. Can I watch this on, I guess we'll watch this on, let me see. Whoop, hold on here. It was kind of large. Wish I had this on, what is this, a pop-out window? Nope, that's wrong too. Oh, the YouTube? Let's see. Continue. There we go.
Other financial institutions.
All right, that's better, isn't it? Hold on here. I think that's, let me see my cursor here. That looks pretty good. Now we're also going to have a news squawker in the background reading.
Commentary then, Wells Fargo. They expect the FOMC to remain on hold at its meeting. So they said, with the FOMC remained on hold on January 29th meeting, a strong economic environment and policy uncertainty left it operating in a wait-and-see mode. Economic activity has moderated since then. The labour market has continued to cool and consumer spending experienced a lackluster start to the year. Even so, we expect the FOMC to remain on hold at the conclusion of its March 19th meeting. The cooling labour market has been gradual, and inflation, though it remains frustratingly above the committee's 2% target, has cooled. The core consumer price index subsided to its lowest year-over-year rate since 2021 in February.
VIX 9-day looking bullish here.
Does not need to be in a hurry to adjust its stance on policy.
And the top here is going to be SPY for you.
London met with Business and Trade Secretary Reynolds.
Over there, you're going to see, I'll put up the, you know what I'll do is I'll make this SPY. Hold on a second. I'll make this easier. This might be better if I do SPOOs. I'll make this one SPY right here.
So London and Reynolds discuss potential bilateral trade agreement. So about 10 minutes ago, until we get the Fed interest rate decision, forecast is for no change prior 4.5%. We also get the SEP, or the Summary of Economic Projections, alongside the FOMC rate statement. Then we're looking at the median rate forecast then for the Fed. For the current is 3.875%. Prior was 4.375%. For the Fed median rate forecast in the long run, forecast is 3.125%, prior 3%. For the next 2 years, Fed median rate forecast expectation is 3.125% from the prior of 3.375%. And the year ahead Fed median rate expectation forecast 3.375%, prior 3.875%.
So I've got Dixie set up to on the top left. In the middle will be VIX 9-day.
And then more from Wells Fargo, they say the conclusion of March meeting will bring an updated SEP. They expect the median participant to continue to reflect 50 basis points of further easing this year. Though if there were to be a move in expected easing, we believe the risks are skewed more towards 75 basis points rather than 25 basis points. Our own forecast calls for 75 basis points over the rest of the year, as we believe the slowdown in the labour market will lead the committee to cut in June, in addition to cuts in September and December. UBS say Powell is expected to deliver a stronger message on restoring price stability at the upcoming FOMC meeting. Rates are unlikely to be cut, though there is some risk of tapering balance sheet runoff. The key focus will be the SEP and Powell's conference. Given worsening inflation data, the dot plot median is expected to remove a 2024 rate cut with a possibility of no cuts in 2025. However, a one cut median remains the base case, and Powell's rhetoric is expected to be more forceful, signaling a do whatever it takes approach. In the ECP, unemployment rate may be revised down, while real GDP growth is likely to be marked lower. Improved productivity could lead an upward revision of longer run GDP growth median. Core PC inflation for 2025 is expected to be revised up, with anticipated 0.34% February increase sustaining higher inflation estimates. This could push median dots higher, effectively cancelling out a potential rate cut. The FOMC is expected to project inflation reaching its 2% target by 2027. And then with the UniCredit, they say the Fed is expected to keep rate unchanged. Powell emphasized patience in adjusting rates. Interesting commentary here from Hamas saying the Israeli ground operation and incursion into Netrazarim corridor is new and dangerous violation to ceasefire deal. They also say, so UniCredit says, going back to the prep, the economic outlook remains uncertain due to Trump's policy measures, including tariffs. A decline in real PCE was likely weather-related, but weak consumer sentiment and lower equity prices pose risks. Short-term inflation expectations have risen due to tariff concerns, with further potential trade actions expected in April.
So in 5 minutes' time now, at the top of the hour, we see the release of the US interest rate decision. Forecast sees the rate unchanged at 4.5%. We also get the Fed summary of economic projections, which comes with the median rate forecasts. The current year, the forecast is 3.875% on the prior 4.375%, with a range of 4.375% to 3.625% expected. For the next year, forecast is 3.5% on the prior 3.875%, with a range of 3.875 to 3.125% expected. For the next 2 years, the forecast is 3.125% on the prior 3.375%, with a range of 3.375 to 3.125% expected. And over the long run, the forecast is 3.125% on the prior 3%, with a range of 3.125% to 3%. With this as well, we also get the FOMC rate statements.
The yield's on the rise right now. How are all you guys doing out there? Good to see you, Macro Pup. How are you? Thanks, Stacy. I'll read a few things to you guys right now. Brian Bingham saying from Goldman Short Macro Trading. No expectations for changing the policy rate, going in with 0. Priced in the meeting, and everyone can agree rate decision is a non-event. Beyond the decision, this is the most interesting meeting in a while. Markets focus is going to be on the 2025 dot. In December 24, had a split vote for a 2-cut median for 25, despite the market expecting closer to 3.625. With that being said, we think it is highly likely that the 2025 dot remains at a 2-cut median. Though in line with GIR's forecast, the average of these dots is likely to go up, given 1, regional Fed presidents have come out more hawkish, and 2, likely dovish lower votes shift their vote higher to 3.875 clearing point. A lot of that has already been priced following the 25 BP sell-off in Z5 over the last 5 trading sessions. I think the pain trade would be if this dot ticks back up, front-end longs in May, June, and Z5. Implicit longs and forward steepeners like 3-year, 2-year, 5-year, 5-year, even tangential longs and risk assets or equities would suffer in an environment where Fed is delivering
I'll lead with the U.S. interest rate decision.
I'm going to stop there. Delivering an openly hawkish message. With that being said, we think levels in the front end remain isometric to the long side. Over the next 2 to 3 month horizon, we think the sole focus will turn to the labor market and anticipate quickly entering an environment in which all it takes is one bad data print for the market to extrapolate weakness. Remember, this is a short trader. I'm going to quiet down from what he has to say here. One more note. When Powell is inevitably asked in the Q&A if he does not give forward guidance, we think that would be extremely bearish for spreads. A lot of bear shit coming out right now. SPOO's weak right now.
No change, no change. Rate remains unchanged at 4.5% as expected. Fed medium rate forecast current year 3.875%, 3.875% as expected.
SPOO's squeezing.
3.375%, 3.375% as expected. Next 2 years 3.125%, 3.125% as expected. But the long run at 3%, lower than forecast 3.125%. So looking to the market, seeing some weakness in the dollar and some strength in the S&P 500.
Weakness in TNX as well. SPOO's squeezing right now.
Unemployment rate has stabilized at a low level and labor market conditions remain solid. The Fed expects the economy to continue to expand at a solid pace. They say risks to both sides of its dual mandate in the statement no longer say that risks are roughly balanced. So again, saying there are risks to both sides, but have removed the roughly balanced element. So Fed projections show economic growth slowing in 2025 and inflation remaining further above the 2% target. The projections show that 4 of 19 officials see no cuts in 2025. 4 see 1 cut, 9 see 2 cuts, and 2 see 3 cuts. So Fed projections implying 50 basis points of rate cuts in 2025 and 50 basis points more in 2026. Fed policymakers see 2025 PCE inflation at 2.7%, up from the 2.5% in December, core seen at 2.8%, up from 2.5%. Policymakers see 4.4% unemployment rate at the end of 2025 against 4.3% in the December projections. A Treasury redemptions cap will decline to $5 billion from $25 billion. Monthly redemption caps on MBS is unchanged, though, at $35 billion. The Fed say beginning in April, the Fed will slow the pace of balance sheet runoff. The committee is attentive to both sides of the risks of its mandate. Again, did remove the area where they said roughly balanced. So the Fed vote on policy included one dissent from Governor Waller, who supported no change on the policy rate, but preferred no change to balance sheet runoff as well. So again, Fed officials' median view of the Fed funds rate at the end of 2026 is 3.4%, unchanged. So for the end of 2025, they see it at 3.9%, unchanged. Longer run, 3% unchanged as well.
TNX reacting very well to the Fed stating that beginning in April, the Fed will slow the pace of balance sheet runoff sooner than the May or June expectation to calm volatility in the marketplace.
Fed policymakers see 1.7% GDP growth in 2025 from 2.1% in December, and they see longer run growth at 1.8% from 1.8% in December.
Fed officials' median view of Fed funds rate at end 2025, 3.9%, unchanged from previously 3.9%.
So again, seeing LSEG estimates come out now. U.S. interest rate futures pricing in 56 basis points in cuts this year after the Fed holds the rate steady, unchanged from the prior.
I think that's where we were before, too. Dixie getting hammered right now. FOMC median 2025 unemployment projection rises to 4.4%. I think we're at 4.1 right now.
So just again, looking to the markets here, strength in the S&P 500, weakness in the dollar here. SEP showed lower than expected GDP expectations and higher than expected inflation expectations. And the Fed's median rate forecasts were as expected, though lower than the prior December SEP.
Fed omits language about Fed's goals being roughly in balance. U.S. interest rate decision actual 4.5, forecast 4.5 unchanged. Median rate forecast current 3.875, forecast 3.875. Previous was 4.375.
Special offer of Financial Use Pro for a year's worth of our service for the price of 1 month. And
so the previous was 4.375. The forecast now 3.875. The Fed median rate forecast long run actual 3%. The forecast was 3.125. Previous was 3%. Fed median rate forecast next year, actual 3.375, forecast 3.375. Previous was 3.875. Some deteriorating economic conditions. Fed monthly Treasury redemption cap will decline to $5 billion from $25 billion. Monthly redemption cap on mortgage-backed securities MBS is unchanged at $35 billion. Fed vote on policy included one dissent from Governor Waller, who supported no change on policy rate, but preferred no change to balance sheet runoff. God damn, Waller. Ooh. Let me get the statement for you guys and post it inside of the Pro channel here. Dixie bouncing on the half right now. I don't like the Fed omitting language about Fed's goal being roughly in balance. Fed sharply reduces 2025 growth projections, marks up inflation. Fed uncertainty around economic outlook has increased. That's all negative. FOMC median forecast shows 50 BPS of rate cuts in 2025 to 3.9%. Fed to slow balance sheet runoff starting April 1st. Already told you that one.
Says this is a dovish Fed.
But the Fed is now also saying the economy there's some mixed language here. Fed economy continues to expand at a solid pace. Fed also saying inflation remains somewhat elevated. Yeah, this is a dovish fucking Fed for sure. Futures implied traders see 62.1% chance of Fed resuming rate cuts in the June meeting. It was 57% before the Fed decision. There's like at least a trading idea of a Fed put. There's the question: is there a Fed put? Is there not a Fed put? But this sounds, it's J.P. Morgan's Michelle saying this is a dovish Fed. You're seeing the Fed, and if you earlier there was a question about a Trump put or a Fed put. There's leaning into a Fed put. I do wonder the implications of this. In terms of Jerome staying on board as the Fed chair in May. This would appease Trump possibly or slightly. I would have to read to see if Trump makes any commentary or if he's going to wait until after the presser. But man, how do you get rid of J. Powell? Like, how the fuck do you get rid of J. Powell? Like he's signaling fealty to the king. He's willing to play ball with uncertain economic conditions. This is going to be fascinating to listen to him talk. He said a lot here. Or not he said a lot, but the press release is saying a lot. I'm reading through it right now, and there's expansion and discussion in this. Waller, Waller, fucking Waller's like, fuck the Fed's checking account. Like he wants a revisit of 2019. I think that's what he said, unless I'm wrong here. Well, but this looks like projecting, looks like the Fed is projecting a hit from policy and tariffs and reciprocal tariffs, or at least acknowledging it. And then it's also acknowledging, hey, let's slow the pace of QT, and also we're open to bigger cuts in 25 and 26 if needed. There's a big line in here. Which line was this? I gotta. What did he say here? There was some change of language here, which was fuck is that language? Sorry for swearing. There was a change here in language that was pretty significant. I'm missing it now. God damn it. There was mixed mess. Yeah, right here. The Fed omits language about Fed's goal being roughly in balance. That's huge. And then, but also countering that with saying economy continues to expand at a solid pace. Like there was a real. I read some articles to you earlier from December, January, and March, where there was I don't know if you guys remember this. I went over this morning in the stream, but in December, January, February, there's a question of is the Fed chair kind of hogtied with his chair position being over in May, right? And where the economic data is that he can't really do anything. And
from Wall Street Journal's Tim Morales on X, say Fed officials marked down their forecast for GDP and up their forecast of inflation and unemployment, but almost all of them see the risks to the downside being on growth, and almost all of them see the risks to their to the unemployment and inflation forecasts to the upside.
there's an expansion in a willingness to deal with that.
I've posted out Tim Morales' article on the feed for those interested.
Uncertainty from the White House or from White House policy, from tariffs, reciprocal tariffs, and even policy in and of itself. I don't know if I'd describe it like more expansive. Now, we were reading some articles earlier today from, if we forget that, like we always have, we have the forward vision too, where we forget certain information. If we were looking back in December, January, March, there was a feeling amongst the bond market, the stock market, participants that growth was out of control, and that the market would self-regulate it if the Fed can't do anything. And you can see at this point that there has been pullbacks in the market, right? You can see that clear as day that the market is regulating itself and retarding growth in the economy. Nice little bounce here in SPOOs. We're just awaiting here at the next 15 minutes. Be careful of another downside spike into the presser here. I'm fascinated to hear. This is interesting. I would definitely say this was unexpected. This is assertive from Jerome Powell. Yeah, a second here. I'm sure there's bears out there pissy about the GDP growth projection. Market should be down on that, right? That's what I'm going to assume here. But in actuality, there was a fear in the fall and winter of too much growth. And lots of doom headlines. I don't see anything from Donald Trump yet. Well, I'm reading Nick Timmeros right now. Oh, come on. The fuck, man. Oh. Back.
So just a heads up for users, we have posted out the live feed of the press conference, which is due to start at the bottom of the hour with Fed's Powell.
Let me read what Timmeros is saying here. The Fed holds rates steady. The median of the rate cut forecasts are unchanged from December, still at 2-cut median. Fed slows Treasury runoff. Yippee. We already knew that was going to happen today. Chris Waller dissents in the QT decision. Fucking savage. Fed officials marked down their forecasts for GDP and up their forecasts of inflation and unemployment, but almost all of them see the risks to the downside on growth. They want to make that known. That's AKA we're doves. Heel to Trump, and almost all of them see the risks to their unemployment and inflation forecasts to the upside. One comment's talking about gold markets. Gold market has nothing. Gold market has to do with war. These fucking these commenters are fucking sorry. This comments on FinTwit are fucking bizarre sometimes. If you got like 1 million people following you, no, it's not none of you guys, but I don't know if they're bots or who they are. Fealty from the Fed. Let me ask you guys a question right now. Like Jerome is not like the boat rocker at all, is he? Do you guys think that Jerome is looking to be the chair for another term? This looks like it. This looks like Jerome's. This looks like fealty. He could have been like, "Fuck off." Sorry, I haven't even been drinking yet. I poured myself a drink. I haven't even had a cocktail. I'm like, well, it's FOMC. It's been a long ass week. I got one sitting right here. I haven't touched it. Yeah, well, like there's like from Powell, it's like there's a couple key changes here that I wasn't expecting Powell to say that, or I wasn't expecting Powell to be so expansive, right, accommodating right now, which he absolutely is, and opening the conversation wider. This, I mean, you figure if he's a lay, what were they saying? They're saying in the Bloomberg was saying like in like December, January, February. I was reading articles to you guys earlier today. They're saying he's a lame duck, and lame duck implies that he's not playing ball. And I think Bessent had said something along the lines of if Trump asked him to step down, he wouldn't, but if he told him, he would. There's some like key verbiage in there. There's some Kashkari must be like fist shaking right now.
With Fed's Powell. Reminder, the video is on the feed for you to watch live.
Kashkari's going to be angry right now. Like, VIX cooling off right now too. Remember, SPX at the money vol was spiking today, expected to drop after this event. Dixie is on support right now in the half an hour and 1 hour trigger. You got 10 minutes until the presser begins. What else do we got here? I mean, I don't know what to say about Timros here. Like, I mean, Timros has nothing. I'm trying to read anything from Timros here that means anything, but I think we can all figure that out. Yeah, so Timros was also talking about the debt limit today. Nice little bounce there on the hourly trigger. Do you guys think? Let me go into the Discord. Hold on here. Let me ask the Discord here. I can't read all the chat. There's like a million chats going on right now. I really want to know if anyone thinks that Jerome is pining for what do you call it? Continue to be the chair. Seven more minutes here. That 5685 still remains to the upside. Still hasn't been tagged. 5700 hasn't been tagged either. Let me see here. You think Waller's in the running? Maybe, probably not, right? Waller's automatically excluded. Bo Rush saying no. Yield Maximus saying drama. Bowman is the next chair. That's a fair point. Steve H saying doesn't matter, does it? Trump wants his man in there anyway. Well, Jerome is his man. Jay Powell is kind of his man. He's kind of showing fealty right now. I gotta admit.
Going to get the FOMC press conference.
Doesn't matter. He's the last one. Ooh, photon trader. Yikes. E-Man saying, I would say so. Old assholes want to retain power for as long as possible. I mean, if Jay Powell retires, he still has another 2 years at the Fed. He'll be in the Fed for another 2 years regardless, even if he steps down. I think he stays in the Fed unless he goes, I'm out of here. He can remain in the Fed, I think. I might be wrong on that, but I think he can. Well, that's a fair point from Steve H. He wants his man in there. Maybe, that could be true. Steve H might be right because Trump has a habit of anyone not do, like, if Trump hires somebody and they do anything outside of what he wants, fired. Steve H has a good point there. If Jay Powell retires with the way this administration is going, they'll probably find a way to appoint Sin Bankman-Fried. Let me ask you another question, a secondary question. If Jay Powell is removed, if we don't know who the replacement would be, do you think there'll be a shock to the market? Do you think there's any shock to the market, or it could go either way, shock to the upside or downside? Everything is not always about Trump. Orange Man is in your head. Trump is a completely different boss than his predecessor. Breaking guy having a bad day with a shotgun brings CIA headquarters to a standstill. Creates opportunity for hundreds of law enforcement to stand around and be not actually concerned about anything. Oh, there's the next one. This is a good one. Pesky B said, What color will the tie be? That could imply if he's going to be asked to be if he's going to get on the knee and beg to be the chair again. The story behind Powell and Trump is funny. Yes, it is. 100%. Herschel Walker. Oh, God. I'm with that. Herschel Walker, next Fed chair. It said Trump wanted to fire him, but he can't. He did. We were discussing that in the show earlier this morning. There was an idea of a shadow chair. Besant had brought that up, or there was rumors of that.
JP Morgan's Michelle.
He can't fire him, but his term is up in May.
Jump to conclusions.
Short-term shock. Yeah, BBG is dooming like crazy right now. They rolled out the whole bear carpet.
Protect your trades from macro headline.
Yeah, Jerome said that he wouldn't be adversarial any longer, that those days are over. He's only been adversarial briefly when he felt like the mass media was calling him out. This May, Powell, like many government officials, have been able to do insider trading. Powell, like many government officials, has been able to do insider trading on his own decisions.
The press conference.
Oh, my spelling sucks here. Sorry about that. Could be very bullish if done correctly. Hold on a second here. Talk of. Oh, hold on a second here. Hold on a second here.
Good afternoon. Good afternoon. My colleagues and I remain squarely focused.
Powell
on
says the
achieving
economy is strong.
Voice news
for the
disconnected.
benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year,
That's fine.
0.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data.
Who's rising on all of this?
Prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Howard.
Howard Schneider with Reuters. Thanks for your time. So 2 things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory, and that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am.
Colby.
Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations, and people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example, then you have market-based, and it's the same pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys, but if you look out 5 years or the 5-year forward, you'll see that break-evens are either flat or actually slightly down in the case of the longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Nick Timmeros, The Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms.
Can you say that today, that we have that price stability, that households and businesses are ignoring price growth? When you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation?
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can make their daily economic decisions in businesses and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low twos in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
So again, people wrote down 2 cuts the last time, and they look at the they wrote down meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3. And so those kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment, pretty close to its natural level. But job the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs, so you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer.
Dixie coming into a pivot point.
Which way does that break? If we were to see a meaningful increase,
Phoenix coming into some support.
that would probably translate fairly quickly into unemployment because people are, it's
6-9 day looking to bloodbath here.
We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other?
In labor and inflation, just across the economy, have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area, but at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with, it's either noise and it'll come back, and that's very possible too. But if it is persistent, then it must be to do with people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up. But prices also went up on dryers, which were not tariffed. So the manufacturers they just kind of followed the crowd and raised it. So things happen very indirectly. And so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Vic's getting shanked.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into service?
Oh, here comes the bear.
Everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last?
Pandemic, yes, during the
Because
pandemic.
you could have been talking about the last time there were tariffs.
I thought he was talking about right now. Oh, all right. He's talking about 2018.
No, of course, we're well aware of that. And, it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect by design, you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation. There are differences and similarities. I mean, it's a different time. We haven't had real price stability fully reestablished yet, and we have to keep that in mind. And we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Policeman, CNBC. Thanks for.
Oh, here we go.
Chairman.
Steve Policeman.
Last policy statement said monetary policy cannot offset.
It's the closed captioning said Steve Policeman.
Prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
You know, so we have two goals, right? We have maximum employment and price stability, and we have to balance those. And, you know, there can be situations in which they're in tension, right? And we actually have a provision in our consensus statement that says what we should do in that case. That's a very challenging, you know, situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is, each of those two measures is from its goal, and then we'll ask how long we think it might take to get back to the goal for each of them, and we'll make a judgment because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say, we don't have that situation right now. That's not where the economy is at all. It's also not where the forecast is. I don't know any mainstream forecasts that really show significant problems like that.
Well, just to follow up, yesterday, the UCLA Anderson forecast said there's high probability of a recession. Where do you stand on whether or not the slowdown you're seeing creates a higher probability or concern that you may have on recession? Thank you.
You know, there's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, there could be within 12 months a 1 in 4 chance of a recession. So the question is whether whether this current situation, those possibilities are elevated. I will say this. We don't make such a forecast. If you look at outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels, you know, still in the region of the traditional, because they were extremely low. If you go back to—
That was a target hit.
We're saying that the likelihood of a recession was extremely low. So
Powell, 5,700.
Hi, thank you. Chris Rugaber at Associated Press. As you know, I guess last night President Trump fired 2 members of the Federal Trade Commission, an independent agency, and this could cause the kind of legal fight about the administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed board?
So I think I did answer that question in this very room some time ago, and I have no desire to change that answer and have nothing new for you on that today.
Well, maybe I'll have another mulligan. As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing that, what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer term thing. You know, we look at it, we don't dismiss data that we don't like, we force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based assessments of longer run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that one's kind of an outlier, but you know, nonetheless, we take notice of it.
Thank you.
Michael McKee from Bloomberg Radio and Television. There's a worry on Wall Street that when you say you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to any downturn. How can you reassure people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of we're well aware of how things are going to evolve and the timeframes and all that. And you know, we will use our tools to foster achievement of our goals to the best we can. And of course, we're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty. And we're watching that carefully, and we think it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. These decisions are going to be made, and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. Those things will happen. A lot of them will happen over the course of, in coming months, certainly over the course of this year, and we'll be adapting as we go.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months, if there were specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain and that you're reading about developments. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it's not really telling you anything. You're trying to extract a signal from that, and the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was?
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. With the idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string of readings that average close to zero, and you have to ask, it's coming during tariffs, but you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories, which will shortly reverse, and that happens too, and that could be a big piece of it. I think we'll know. In a couple of months, we'll know whether those were, where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs and how much of it didn't. But that's what we'll be doing. And we'll be doing that, and so will everybody else, and we'll all be trying very hard to make that assessment. And, I'm sure we will make a lot of progress on that, and we already have. But it's going to be a challenge.
Do you have a sense yet as to what, in your mind, would make something cross from noise to a signal, what that threshold would look like?
It would depend on what we're talking about. I mean, obviously, you're looking for direct evidence that particular pieces of inflation are or are clearly not caused by tariffs. For example, if it's something that was, in the service sector that was far away from anything that's tariffed, you might think, okay, well, that is, like, frankly, housing services inflation, which, by the way, has been behaving well, which for some time was kind of our problem. Now it's slow, but it's definitely, moving down in a very good way. It's more now with goods and to some extent with non-housing services inflation.
Kelly.
Thanks for taking our questions, Chair Powell. Kelly O'Grady, CBS News. So consumer sentiment has dipped dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices. It's they're unhappy, and they're not wrong to be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental.
Spoo's trying to squeeze to 5,700 on SPX.
People are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment is high. It's none of those things. We have, 4.1% unemployment. We've got 2% growth, and it's a pretty good economy. But people are unhappy because of the price level, and we completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer? Does that mean you see a slowdown in economic growth as a real threat?
So I think remember we came into this with, at the December meeting, the median was 2 cuts, the median was. And so you come in and you see, broadly speaking, weaker growth but higher inflation. And they kind of balance each other out. So you think, and unemployment is really, there's really only a 1/10 change. So there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth and meaningfully higher inflation, which call for different responses, right? So they cancel each other out, and people just said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. Is just, we're sitting here thinking, and we obviously are in touch with businesses and households all over the country. We have an extraordinary network of contacts that come in through the reserve banks and put in the beige book, and also through contacts at the board. And we get all that, and we do understand that sentiment has fallen off pretty sharply, but economic activity has not yet. And so we're watching carefully. So I would tell people that the economy seems to be healthy. We understand that sentiment is quite negative at this time, and that probably has to do with turmoil at the beginning of an administration that's making big changes in areas of policy, and that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more at the price level.
Victoria. Hi, Victoria Guido with Politico. I wanted to ask, first of all, if you could clarify. You were talking about how tariffs were...
Squeeze them the fuck out. Just push it up there. Jesus Christ.
What that specifically refers to, is that the tariffs that have already been put in place? Is that anticipating some of the tariffs that might be coming?
Just a note to you out there here. I'm going to interrupt really quick. I don't mean to interrupt her particularly, but when this presser ends, if you're long,
might affect the reserve supply.
wrap that shit up.
You'll see that there's
wrap it up.
On core inflation this year. We're kind of...
If we go up and trade 5,700 in SPX or anything like that, there's enough time for it, that's great, but moment this fucking presser ends, people are going to take their money and fucking run.
We know that they're probably already...
Maybe 7 out of 10 times. 7 out of 10.
Core CPI inflation this year, without exception.
5,700 or end of presser.
In terms of the balance sheet, so yeah, I think, I guess the way I'd say it is, it was the flows.
I bought fucking Ford yesterday. It's up 3% today.
Got us thinking about it, but as we thought about it, we really came to the view that this was a good time to...
Well, I can't believe that.
And broadly, committee that came around to the view that we would do the same thing we'd already done, which is I guess in June, was it June, whenever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly.
Yeah, put that pump out there for lowering QT. Yeah, do it.
If you're cutting the pace of QT roughly in half, then the runway is probably doubled.
Yeah.
It's going to be...
This is murder and volatility, by the way, this conversation.
People thought that's a good idea. It's like a plane. You can think of it like a plane coming in for a landing. As we get closer, and we by the way, we still think that reserves are abundant, although you begin to see some of the things we look at begin to react a little bit, but we still think that they're abundant. Now, of course, now the TGA is emptying out, so reserves are higher now, so you can't really see the underlying signal. So we came around to the view, and it had a lot of appeal, and so we did it. It has no implications at all for monetary policy. It has no...
There ain't shit above this. There's no gamma above. I mean, there's gamma. Oh, there it is. There it is. There it is. There it is.
Try to tease out. It's just not...
5,700 tag.
With our plans and our practice
into supply
that we followed since we began this, what is a very successful...
Yeah.
Rundown of the balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when...
Also coming into R3 on SPY at 57036 on SPY.
Kind of a thing, and it had pretty broad appeal, I will say.
R3 on SPX 5703.
inflation expectations remained well anchored, would you still say
5,700, a giant put bar up there.
the
Just hammering puts at 5,700.
why hasn't there been a more radical shift?
If there's a breakout above 5,700, woo!
When we talk about inflation expectations being well anchored, we're talking about longer run inflation expectations.
Gamma flip at 57.52.
Much. I mean, if at all. There's one reading that everyone's focusing on that it's higher, but the other survey readings and the market-based readings all show relatively, well anchored.
There ain't shit above.
You would expect.
There ain't shit above the 5,800, to be honest.
Over the course of a year would move around because conditions change, and in this case, we have tariffs coming in. We don't know how big, what speed. There's so many things we don't know. But
I'm almost green on SPY.
They tend to bring growth down.
I'm not all right. I'll be quiet here. Okay, I gotta calm down.
So I would say,
I gotta calm the fuck down because that would freak me the fuck out.
follow that very carefully. But
I'm like goddamn like $3 away.
Well anchored, we're really looking at longer terms, 5 year and out, and there's really no story to tell 5 years and out, either in market. But we'll watch.
Booze.
We're not going to miss any evidence that longer term or medium term inflation expectations are moving.
I gotta write fuck your puts at 5,700.
Chair Powell, Neil Irwin with Axios. Treasury Secretary Bessent has observed that a large share of job growth over the last couple of years has been in what he calls government or government-adjacent sectors, healthcare, education. Do you agree that there's some weakness in underlying private job growth, and do you see the composition of job growth as something that has policy implications?
That has been the case. We talked about that over the course of the last year. There were some good number of months and times when.
Oh yeah, baby, squeeze it.
In, educational institutions, healthcare, state governments, things like that. There were also times when private sector job growth has been moving in a healthy range. I mean, they're all jobs, but and remember, we're at very low unemployment for quite a time now. So I think it's a good labor market, but it's something that we monitor carefully. From our standpoint, employment is employment. But the elected government is entitled to have, we don't have policies that address different kinds of employment, but the elected government has a different role, and they can have those.
Here's a quick QT question. Does the committee envision at some point tapering the MBS runoff as well?
I think tapering it, I don't know. There's no plan to do that. At a certain point, we'll stop runoff. And we may or may not stop MBS runoff, though, because we want to stop runoff in net at some point. We haven't made any decisions about that. We want the MBS to roll off our balance sheet. We really strongly desire that. So, but we haven't made any decisions about that. I think we'd look carefully at letting that keep going, but hold the overall size of the balance sheet in, constant at some point, a point that we're not out yet.
Simon.
Simon Rabinovich with The Economist. Thank you, Chair Powell. Several times today you've said that you feel you're well positioned to wait for greater clarity. At the same time, you could point to quite a few growth risks at the moment. We've seen a stock market that's gone quite wild. Rapidly growing housing sales, plunge in confidence surveys. Today, not only did the S&P market...
Spoo's now cranking past R3 towards R4, R5.
So my question is, how confident are you that you're well positioned, or is that one more thing that you're uncertain about?
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy. And that's what I mean. I think that's well positioned. Forecasting right now, forecasting is always very, very hard. And in the current situation, I just think uncertainty is remarkably high.
And sorry, standing here today, would you be surprised to pivot back towards rate cuts in May?
I think we're not going to be in any hurry to move. As I mentioned, I think we're we're well positioned to wait for further clarity and not in any hurry.
Matt.
Matt Egan with CNN. Thank you, Chair Powell. The Fed statement released today removed a line that previously said the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Can you explain the decision to remove that line? Does it mean that you're now more concerned about inflation or about employment?
Actually, it does not mean either of those things. You know, sometimes with language, it lives its useful life, and then we take it off, and that was the case here. There's really not meant to be any signal here. Over the past year, you know, conveying this sense of the balance of risks was important, that they be in balance or close to being in balance. That was useful as we approached liftoff, if you remember, but we're past that. Or sorry, no, beginning to cut. So we just took it out. I actually would say that the more important thing now about risks, and this is in the pages like 10, 11, 12 of the SEP, if you look, participants widely raised their estimate of the risks to our of uncertainty, but also of the risks to growth and our employment and inflation mandates. That's a more salient point now than whether they're in balance.
Just on the stock market has obviously declined significantly since.
This guy likes cocaine, you can tell.
Are you concerned at all about some of the market volatility having a real economic impact in terms of hurting business spending or consumer spending, especially among higher income households?
Just a note here, this should end by 5:20-ish.
Because, you know, financial
next 7 minutes.
To the real economy through which our policy has its effects, so they're important. But what matters from a Fed standpoint for the macro economy.
Anyone getting short here?
Changes to overall financial conditions that are persistent, that last for a while, long enough to actually affect economic activity. So that's what we're looking for. I'm not going to opine on the appropriate level of any market, equity, debt, commodities, or anything like that. And I would just point you.
I should have stayed in longer.
You know, the real economy, the hard data, are still in reasonably good shape. It's the soft data, it's the surveys that are showing.
I don't want to be greedy. Don't be greedy.
Significant concerns, downside risks, and those kind of things. We don't dismiss that. We're watching it carefully, but you know, we don't want to get ahead of that. You know, we want to focus on the hard data. If that's going to affect the hard data, we should know it very quickly, and of course we'll understand that. But you don't see that yet.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you look to navigate higher inflation and lower growth, the Fed has talked about heeding the lessons from the 1970s. Is the Fed willing to have a recession if it means breaking the back of inflation?
Well,
oh God.
Fortunately,
Jesus Christ.
We have seen inflation.
They always bring out the fucking.
While the unemployment rate has remained very consistent with full employment, 4.1%. So
Dixie on the rise right now. VIX 9-day still getting murdered.
But the underlying inflationary picture before that was, you know, basically 2.5% inflation, I would say, and 2% growth and 4% unemployment. So that's what we did. That's what together the economy.
Yeah, I'm kind of bearish into the close once this ends. It looks like these reporters that they're bringing out are the end here.
You know, inflation, underlying inflation is you know, still running in the 2s, with probably a little bit of a pickup associated with tariffs.
You guys want to get back in again?
I don't think.
Yeah, this could be support too. There's 2 ways of looking at this. If we can hold 5,700, we will hunt down the gamma flip higher, but
To every taxpayer from
it looks like a trap to me. I would like to see the retracement and then the attack higher again afterwards over the course of like 4 or 5 sessions.
on household savings. And
But I can see the thesis here.
of your growth and outlook for inflation.
I mean, there are no calls above.
For me to speculate on.
There are no calls until 6,000. Let me show you guys something here.
Daniel.
I'll post this on Twitter.
Hi, Chair Powell. Daniel Avis from Agence France Presse. You mentioned that tariffs are already having at least some impact on inflation. I'm just wondering how you and your colleagues on the FOMC have been thinking about the possibility of retaliatory tariffs from other countries, especially with April the 2nd coming up. Was it something you considered during this meeting? Thanks.
So since the very beginning, we've had kind of a placeholder. The staff has a placeholder of a range of possible outcomes from tariffs and from trade policy generally, and they generally assume full retaliation in those. And so that's kind of baked into the numbers. What happens, it will be complicated, and there will be some retaliation and some not, and all that. But ultimately, they're trying to, with the placeholder, give us a broad sense of what this might look like. When we actually know the specifics, we'll be able to have still uncertain, but better informed forecasts. So yes, that's in there.
Last question goes to Jean. Hi, Chair Powell. Jean Young with MNI Market News. Had a couple questions on the balance sheet change that you made. So the minutes had initially described your discussion on slowing QT as temporary until the debt ceiling is resolved. But from what you said earlier, it doesn't sound like there's a desire to kind of regain the pace of QT that we have at the moment after the debt ceiling is resolved. Is that the case?
Yeah, so we looked at pausing and we looked at slowing, and really people came together very strongly behind slowing, not pausing, for a variety of reasons. And so people really came to be, pretty strongly in favor of this move. It slows down the path and probably lengthens it, doubles it effectively by slowing by half. That people thought that's a good place to be. It'll help us assure that this path is a smooth one as we get closer and closer to that. So that's how that came about.
Well, I guess my question is more, was that meant to be a temporary measure during the debt ceiling episode, or?
It was the TGA flows, Treasury General Account flows, that got us thinking about this. But the more we thought about it, we came around to this. And it is, yes, it was provoked. The original discussion was provoked by that. But I think what we came up with, though, was broader than that and different than that. It does address that issue, but it really is also, it fits in really nicely with our principles and our plans and the things we've done before and the things we said we would do. So that's why, pretty strong support. I'd just say it's nothing to do with monetary policy, nothing to do with the size of the balance sheet. It's just kind of a common sense adjustment as you get closer and closer. Let's slow down a little bit again, and that way we'll be more and more confident that we're getting where we need to get. You can take our time getting there. We're shrinking the balance sheet every month, and we think it was a good play, and as I mentioned, well supported. Thanks very much.
All right, watch out. Traders are going to take their money and run. Be very careful here. Oh, I'm going to get dinged for that. Hang tight here. I'm going to switch back to... First, I want to thank you for joining us today. We're on Monday through Friday. We are sitting in a supply zone here. This is 5,700. You can see the bar right there, a whole bunch of supply. Give me a second here. I got some wonkiness to do here. Give me one quick second here. What do we got going on here? Let me go back to a one-page view. Go to Spoozy Woozy. Well, thanks for joining us today. Here's the extension of that top up there. So let me go to trigger screen. This is the one from this morning. Top there, there. And right about there. And you want to be really careful of, there's real danger here into the close today. I was drawing this out earlier in the stream. We held the hourly nicely in a back test, but we swooped down here. Literally to 4 p.m. Woof, all that gone. If we can swoop down and maybe hammer that out, but this could take days to move too. And not only that, I want to show you one other thing here. And we'll do this together. Hold on a second here. I do want to show you something here, even for that giant. Like, look at that big giant squeeze right there. Whoop. Don't get too ahead of yourself. Want to show you something here. You know, whenever you're making these moves higher, especially on an event or something like that. One quick second here. Got that nice relief trade here, and if we're gonna go higher, again, stay low. Hang tight a minute here. Oh, ho, ho, ho. You know, I'm going to tell you guys something. There's no gamma. There ain't no fucking gamma above to 6,000. It's just like a straight shot up here for a relief rally. Now, there is something to be said here for if you're a bull and you have a bullish thesis of some kind. I want you to pay close attention to this low right here, right there. Okay. There's nothing saying we have to come back down here the next couple days, but you know, we burn this off, and there's a wick. Whoop. Sorry, I was over exaggerating that a little bit, but you know, you pull this back, you get a quick wick, and then back up here, just like. Maybe it's not exactly, it's slightly higher, like 560 or something. You always want to be down there trying to grab those to the upside. So I'll give you a quick expectation into tomorrow. You guys want an expectation in tomorrow, I'm assuming, here before you get out of here. The one thing that I do want to tell you is that if there's if it was my view, we're going to blood into this bell. You're going to see traders exit all, you know, dealers are going to clean this shit up. And then I would come back 1 to 3 sessions, maybe tomorrow. But what I really want you to do is to, let me just draw this out for you here. Right there. Kind of have this. Think of it something like this right here for now, okay? Oh, they're just accumulating, aren't they? Telling you they're not buying them, but they are buying, aren't they? Look at that. Wicking that shit. Unloading all their doom on you. BBG giving you all the doom. GS giving you all the doom. I unloaded all this doom last night and was like, all right, did we get the doom out of the way? You guys unload all your fucking doom on the market? Your letter. Monthly here. 1 week. That daily candle right there. The you shall not pass candle. Somewhere right in here, you can see it right here. And this is my real, like, look and see how much lower it can come. Check the 1 hour here. This is good. This is productive. Like, we come up here to the monthly, we get above it. We back test it once, right? Come back up here. Personally, let's take a look at this together. So there's a gap down here at 561. And here's 560, right? So we revert down here, smash through this, right? Maybe even slam into this 558 and then higher. And then this is like the Captain Jim James line down here. The one thing I will tell you here is just like quickly look at this with me. Just think about this bottom tick over here, right? Up, 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 right? They did it again up here, same track. If you were a conservative trader, you're down here. You're literally all the way down here, like that. Okay. Now that's the conservative trader. You're gonna get bears that are gonna tell you, and then you can look at this here as a down like that and then up, right? And you've got the prior high, the new high, right? And this would be a giant pump up here. If it's a flat correction, it's going to be like this. This could be like up here and then flat. And this could take multiple sessions. If it's violent, it won't, but you could be down here like this, fucking around. A few sessions here, 25, 26. The hourly trigger is right here. You see this hourly trigger right here. But you get these violent moves down, and it's like wham, and then off and running. So expectations from here: downside move, and look for a bounce, new highs on a smaller time frame, 15-minute time frame, for a turnaround. I think this is pretty conservative here. If you want to snap this, I can change my mind, of course, once we get into the Asian session. We also have we have 2 more days left. So, like we come back down here, cool this off a little bit. before going higher and closing out this stuff here. Some of you probably thinking we're going to do that today. Maybe. I always like being down here. So let's look at a 30-minute basis here and see what we got going on. Sorry, I'm on the wrong charts here, so I apologize. Hold on a minute here. Hold on a second here. Man, this fucking thing is bullish. And the daily velocity is bullish too. This daily velo is fucking bullish on a 30-minute. And this fucking thing is ready to get going. I'll say this. It is possible, man. Right about there. Expectations, pull back to 562.92 for a trip higher to trade 575. But even so, just remember that you guys know what like a daily candle looks like, right? Or wicking looks like. You're like we're on a 30-minute chart right now, but we can easily come down here, right? Wham, and then up here, and then the candle looks like this, right? It's just a stick down here. So be open to that bloodbath down here to 553. I don't see it. I think all this holds here. I think this 1 hour holds, this monthly holds. Check this trend down here. And that's it right there. That's that trend. I'd want to see at least 63. Like buyers, serious buyers down here, real serious buyers down here. I can run away from you too. And there's an argument too. There's one more thing I want to show you here, which is we never hit this upper target. We missed it. So there could be like a bull trap in here. We squeeze higher, tag that, and then you get the roll. Just be cautious of the FOMO gang up here. It's gonna go up a little bit more, bro. It's like a couple bars, and then it's straight back down again. Oh, hold on. So just right there. Always buying pullbacks. Never be chasing. Don't be chubby chasing all that shit. That's my expectation. There's my expectation. Here, you guys can clip that if you want. My expectation is down and then up, but you know how it goes. Bears say it's only going to cascade down. Bulls say it's only going to go up. I'm always looking to be down here in the depths of hell buying shit. So if we pull back down over here and we catch an up and then a new high, we're off and running to the upside. Make sense? Yeah, I think there's like this is end of day stuff. Dealers aren't going to want to fuck with this. I don't think. I could be wrong, but you do this like 20 times or 100 times, you're going to be wrong more than you're right. There are better traders than me out there, so I'd rather err on the side of being a bad trader and just buying dips. I will say one thing for the bulls. Daily Velo on a 30-minute basis is bullish as fuck. And I know everybody, like, I know all these guys are out there dropping hammers on moving higher. And, like, they're like, what's his name from fucking GS this morning was garbage throwing, saying he's like, oh, the squeeze is done and stuff. But we wake up in a fucking, 10 sessions and we're trading 6,000. Remember something, too. I want to talk to you guys about something here. I want to really say something to you. If you hear a bull or a bear out there telling you it's a bear market or top is in, we're not going back, I'm going to tell you something that a lot of you young traders probably don't know. The biggest squeezes are in bear markets. And I mean relentless. We don't go back and fuck with the hourly trigger. We might hit the half an hour trigger. The biggest squeezes are fucking vertical. So if some bear out there is arguing with you, telling you this is the top of the market, ask them that question. Say, are the biggest squeezes in bear markets? And I saw what's his face talking from GS this morning. He's like, I think it's done, and I'm like, this motherfucker's lying. Like, we can go fucking vertical in bear market. If we're in a bear market, then vertical. This is the early stages of a bear market. So if they're either going to agree with you or not. If you like a bear's like, we're in a bear market that was a top forever, say, okay, fuck it. Let's say I agree with you for 5 seconds. In bear markets, we're into the biggest squeezes. Way bigger than any fucking bull market. We literally go vertical. It's like fucking straight up. So ask them to beat that argument. They can't. They either have to say that we're in a bull market, right? Oh, we're going to squeeze a little bit, then it's going to roll, keep rolling. It's going to fucking staircase for the next year. All that kind of bullshit. So we're in a bull market. We won't squeeze like that. We'll just make our way slowly to the upside. It is very possible to go violent to the upside. So just heads up on that. Yeah. Oh, dude, I unloaded like every bear case you could have last night in a brief. And then at the end of it, I go, chins up. Like, stop reading that shit. So, stop fucking drinking that fucking Kool-Aid. So just, I mean, if we start squeezing, yeah, so be it. Like, I own a bunch of underlying, so fuck it, let's squeeze. It'll make my fucking day if we do. If we don't even come back down here or whatever and just start bombing to the upside, so fucking be it. Either way, I win. Like, it doesn't fucking matter. I can't lose in this scenario. So, I don't think I can lose in this scenario. I guess there's something I don't know. I'm not seeing. There's always something that's fucking in your blind spot somewhere. But if you're a bull, don't be chasing this shit just today. Like, in particular, today is like a day that's dealers are aware of all this shit. Every once in a while, like rare, like sometimes I'll see like the market bloodbath in a FOMC, and then like 2 days later it's vertical, straight up. I've seen that a few times. I have seen gap ups after after FOMC, but you trade it like over and over and over and over and over and over and over again. It's always better to just wrap it up, take your money and run, and look for a pullback. Pullbacks are great, man. I know people make fun of buying the dip, but that is the way to be a winning trader as a bull. The same as a bear too. You get a squeeze, you wait for the squeeze to end, you don't short the strength, and then you get in there and you sell the fuck out of it, right? Once it starts failing. So same thing holds true for bears. So oh yeah, I had people asking me yesterday, how does it feel to be losing all my money? I'm $4 away from about $4 away from break even right now. So that angers me. All right, so I will. What time is it right now? It's 3:41. I'll stick with you guys here. I'm gonna I have to do not have to, but I was asked to do a private stream after the close today. Let's put on a 15-minute really quick, see if we can see any action into this close. This is a little bit more, this is more bullish than I was expecting, I'll tell you that. I'll be honest here. I was expecting bloodbath here. Watch that. They never tagged this line here. That gap is still right fucking there, too. Let's, I hate trading this kind of stuff right now. Like, this is not what I like to trade. This is like just begging to get fucking, like, this reminds me of, you are the exit. Come on, buy some calls, bro. I will leave this here for you. This is our 4 and 5 right here. That's our 4 and 5, the yellow box. We did break above our 3. And there's something else to be said here, too. If we're holding 5,700, we start hammering out a bottom on 57, or we start hammering at a bottom on 5,700, and yeah, we're so close, man. Like, I would not be fucking trading this. No goddamn way. Even with the island there. I know there's an island here, but so sketchy. I can't warrant, like, I'm telling you guys, I would not be fucking long here. Don't do it. Traders are going to wait for a pullback. Seriously, don't do it. Even if they squeeze this up, I think it's I just think it's risky. Maybe it's me. I don't know. And always for bulls, if we hit these two targets, it's sell the news. In my view, dealers just want to like sell you calls here to expire worthless. Fuck no, I ain't touching that shit. It really is. It really is it's a degen trade. I mean, I get it. I see it. It's a pure degenerate trade. That right there is a degen trade. Like, if this was like old school, if this was like before 2019, and more importantly before January of 2022, I'd be like, yeah, like arbitrage is hard these days. I rarely see arbitrage like I used to. It's been like a long time. Like old school, you would see that in old school, like this would all happen here, right? This would all die. And then you would see shit like this looking right before 415. You don't see that anymore. Now they do this shit afterwards. They're like, fuck all this. 415 ends, and then they do all their work in there now. Not anymore. This shit's over. Too many fucking people and they're dicking around. Every once in a while you win, but I get it. We're above the 1 minute trigger. I know it's bullshit. I get it. I'm not giving any more fucking money back to the house. I'm tired. I'm getting old. Take my money and run. You're up 7 pennies. I did get in for a little bit. I went big, though. I went big money, so I made some decent cash. But I didn't stay in too long. So I tried to get in. I was in the pro room, and I tried to buy the first back test. And I had a fucking limit order on, and it just ran away from me. And so I was like, well, by the time I get this shit. Then I jumped in later, and I caught part of it. and I didn't want to stay in for the last like 10%, 20%. I didn't want to stay in. I got to stick to my rules. When I stick to my rules, I'm a winning trader very, very consistently. I rarely lose. When I'm losing, it's break even. So very rarely, it's like 1 out of 10 trades, 2 out of 10 trades, a couple break evens maybe, and then some bangers. So I have to stick with my rules. Okay. Look for that sweep lower. Clean up the mess from today. If we can catch a low. I appreciate all of you guys showing up today. If you are wanting to see a private stream to explain triggers and stuff like that, I have a video series on the website, but we'll do a private stream. So that, if I need like a 15-minute break, but I'll do a private stream with you. We can meet back at let's meet back at 5 p.m. and we'll do a quick private stream so that I can explain triggers and all that kind of stuff. Like triggers, yeah. I'll give you a quick thing. So I try to see. I mean, I suck at that. I'm not the best at anything. What I want to talk to you guys about is like, like if you're trading futures, there are much smaller time frames you can trade on. Depending on the time frame that you're in, there are higher percentage wins. But it depends on what you're trading. And not only that, I like to see where everyone is. I like to see when traditional chartists are. I like to see where gamma is. I like to see ICT. I like to see triggers. Triggers like a dumbed down version of ICT. It's for most people out there. And this is the other thing. Like, most traders out there, like, there's a few rules here. Like, you got to remember that most people are bulls. Like 70% of market participants are bulls. So you might see a trader that's like, I'm ticking this and I'm ticking that. I'm doing this or I'm doing that. Or this is that and this is that. I'm awesome. But the truth is that like most traders aren't that either. Most investors aren't like that. They want to keep it simple, and the simpler the better for them. And like dumbing things down can be very profitable over time. Having rules, keeping things simple, you can make a lot of money. So, and then there's like buying the stock market, selling options, repeating. I think John L. talks about that sometimes. Not realizing losses. You can catch grief from people for that too. They get angry about that stuff. But there's no internet points. It's all what you're making for money and what you're doing with it. And if you're having fun with it, paying your bills and shit, it's all that matters. We'll do this in a private stream tonight, but I have a couple tools that aren't released right now. That I want to release that are still not done. That overlays a bunch of this shit together, all of it together, so you can kind of see where everybody's at. But I don't know. We'll talk about it. We'll talk about it after the close today, around 5 p.m. I got something else for you here too. I bought some Ford yesterday. I talked about it earlier this week. I know there's a bunch of doom about Ford and tariffs and all that kind of stuff. I don't know if I'm down right now, but I was up earlier today in Ford. Check that position. I'm up 3% on Ford. Dirt cheap, $8. I think it was trading like $8 or $9 or something. I was like, woohoo! It's probably gonna come down and go red again, but fun, cheap, sell options against it. It's fun doing that shit. Private stream, it's in our Discord. We have a cheap Discord. It's awesome. We've got a great community. Our community is fucking phenomenal. We have some killer community in there. And so you can always go to tradethetrigger.com and join if you want. It's a close-knit community. I'm not giving away any free memberships. I tried that. It's like, I can't do it. It's not worth it. So But if you want to join, you can. It's cheap as fuck. There's people out there charging $1,000 a month. Our community is worth. I should charge $1,000 every month. That's what I should do. Is just make it like one fucking community charge $1,000 a month. That's how good it is. So, but I don't. It's bare minimum. It's to keep out like fucking wolves and fakers and bullshitters and no skin in the game. People that don't trade the market with real money and shit. So, scammers, bots, Russian bots, fucking you name it. Oh, SSR. Yeah, dude. I'll click at everybody. I'll click and at everybody. And at everybody posts with the link to it. Yeah, man. It'll just be a private stream. It's not in public. It was a good day. I'm happy. Dude, I got smoked yesterday. So I took a trade where I snuck out of a trade. And then I couldn't get we couldn't get a catalyst to move yesterday, right? And then I got fucking smoked at the end of the day. First I got smoked. Well, the fucking second trade, I wasn't fucking paying attention. I was off fucking doing other shit, and I started getting smoked. And then it went up again, and I had a second target. I got greedy, came back down, no fucking anything, and then it got burned. I lost a bunch of cash, but I made it all back today, so I'm happy. Nah, I have too much shit going on. Like day trading for me and doing all this shit that I'm doing in the studio is like fucking crazy. I don't like sometimes I like have this I have these like fantasies just like trading alone for like a month. Like I kid you not, like fantasies. But it's whatever. Now I just buy the market when I can and try to do easy stuff. So yeah, I'm happy. I'm happy right now. I'm pretty happy. Okay, so it's 3:53, 7 minutes left. Don't get caught in this shit here in the close. You are exit liquidity here, my man. Even if it squeezes, dude, like there's so many, like these fucking Fed meetings, they literally red bar us straight down into the bell, like violent, big, giant fucking red bars. Like it's just like a fucking dealer's just like straight there, like what the fuck just happened? Don't do it. Even if it does green bar, just don't. Too many times. Too many fucking times in there on a Fed day with that bullshit. Just get murder bot. Webull has a much better feel. I like using both. I'm coming back around to like using Webull with TradingView. I had to get out of the Thinkorswim platform. I went down, so I finally I still have holdings in Thinkorswim, but I went down the Thinkorswim rabbit hole for a few years, and it's so fucking, it's like Apple, like it's its own goddamn garden. And then I would build layouts, and they would fucking delete. I don't know exactly why they were being deleted, but like updates to their fucking website and shit. I got so angry that I was tired of having to fucking rebuild a bunch of layouts in there. Thinkorswim is probably one of my favorite platforms that I've used, but I've had many like, oh, fuck you, buddy. Here's another fucking 10 hours of building shit for yourself. I'm like, I'm done. No more. Yeah, I've had problems with Thinkorswim. They're a great platform. I think it's time. I don't have a ton of time. I need to be informed about changes. I do like the Webull, not after hours, but the overnight charts. I think those are fucking awesome for stocks. They're great. I like looking at those fucking things because I have to draw charts, and I'm like, all right, I got to take into account ES, and then I got to take into account or after hours pre-markets, and then draw this shit out with crayon. And Weeble's helping me to get through some of that stuff, visualize some of that stuff. That's the one thing I like about Weeble right now. Yeah, dude. I used to fucking lose scripts every like 3 to 6 months. Fuck that noise. Fucking dude, I used to have to like build my own volume and market profile scripts. Those fucking things would take me like 3-4 hours. Like, and then I would forget, like, oh, how do I build this fucking script? Oh, all right, it's been fucking 3 months. Fuck that. And I love Thinkorswim. Don't get me wrong. Love drawing lines for Spy to ignore them. I do all right with lines. I do pretty good with them. I think I'm about right about 70% of the time with them in the general direction in targets. I think that's fairly better than a lot of people. So close enough. And that's the other thing. Even when they're wrong, you at least have inflection points with those lines. Then that's the idea behind them. Is that like when I draw lines for like briefs and stuff, it's not like I've explained this before, but it's more to say, like, if I draw a line that's like, hey, we're going up there and then down there, you're not trying to chase this part. You're trying to just be waiting down here. People will be like, oh, cap's bearish. Like people will be like, I'll draw a line, like, let's say in a brief or something, I'll draw some shit like this, and then down, and then up. And they'll be like, well, bro, it only went to here and then up. I'm like, yeah, but I actually give you the inflection points there to there. And I really want you to be a buyer down here and not chasing this bullshit right here. Unless I draw something that's like, if I draw it like this, then yeah, you chase that fucking thing. But always like pullbacks, or if we're in like accumulation or distribution, riding the NAR does a lot of that for me on different time frames. Like we're selling or we're buying on this frame or selling on this frame, which I don't do, or valid below and above. That's a lot of Elliott wave stuff. Some of this stuff involves Elliott wave too. I mean, I practice Elliott wave, but I don't believe in it. I believe in a racer gang with Elliott wave, but I do want to know what the fuck they're thinking. I want to know what Gamma Bros are thinking. I want to know what the fuck traditional guys are thinking, and ICT's thinking, and triggers and velo and momentum and all that kind of shit. So, anyways, hey Chase, good to see you back, brother. I heard you were holding down the fort on Monday for me. I appreciate it, brother. Bring out the murder bot. I hope Jimmy Barry's okay. If you guys see Jimmy Barry anywhere, tell him I said hello. He's unblocked, so everybody gets a second chance, or third chance, or fourth chance, depending upon. I realize everybody gets crazy. I get crazy. I get fucking banned all the time. I get timed out all the time from places. Happens to me too. All right. I'll see most of you tomorrow, and the rest of you I'll see at about 5 p.m. I'm going to take a quick break. I'm going to get my dogs out for a walk. My one dog, I've got a dog mat over here because he's really sad, and I got to take these boys outside, a pound of bourbon, and get sloppy. Fuck yeah, iron ore. Yeah, I want to get. I've been promising David to get him to. I want to send him a bunch of equipment and try to get him set up, but I haven't been able to, and it's been a pain in my ass. I gotta call him actually. I will talk to you guys soon tomorrow. Okay. You guys all have yourself a great day. I'll talk to you guys.